Good morning, everyone. It is 9 a.m. here in New York City. This is Yahoo Finance Live. I'm Brad Smith alongside Julie Hyman. Here are three things that you need to know to start your morning. China's exports plunged over 7% in May from the prior year, far worse than what was predicted by analysts. It's the first drop in 3 months and adds to the fears that the world's second biggest economy is headed for a prolonged slowdown. The read across for global economic demand isn't great and follows a damning outlook from the OECD. The Paris-based organization says that the world's recovery from the dual shocks of COVID and Russia's war in Ukraine that will be weak and inflation plagued. It sees a 2.7% expansion in output this year and a modest pickup in 2024. The so-called market melt-up appears to be broadening. 7 major S&P 500 sectors finished with gains on Tuesday, with financial stocks the big winners there. The moves leave the index just shy of a bull market, which has been driven higher by a handful of big tech names like Apple, Microsoft, and Nvidia. But risks from a potential pain trade aren't being discounted. CFTC data compiled by Bespoke yesterday showed S&P 500 futures are 17.4% short. That's the worst reading since September of 2007. And the SEC's crypto crackdown, that continues. The regulator asking a court for a temporary restraining order to freeze assets tied to Binance US. It says clients could have $2.2 billion at significant risk. The SEC sued the world's largest crypto exchange operator on Monday, accusing it and CEO CZ of operating a web of deception. Action against Coinbase came next. That complaint focused on the trading of what it calls unregulated securities, including tokens like Cardano and Solana.
Well, data out of the world's second biggest economy has been a mixed bag lately, but today's export numbers paint a pretty clear picture. May's figure coming in way below expectations with a 7.5% year-over-year contraction. That's not a good sign for global growth. Joining us now is David Mazza. He is Roundhill Investments Chief Strategy Officer. And Dave, we've really been seeing this sort of China ripple effect sort of day by day as we see different parts of different data points, right? Today, I think luxury companies in Europe, for example, are taking a hit, but we've seen it spread to the U.S. as well. So when you're thinking about strategy, how are you sort of incorporating the China narrative, not just what it's going to mean for China, but what it's going to mean also around the globe?
Yeah, and I think you're hitting the nail on the head. That's actually what's most important when looking at particularly China exports data. And there's no other way to read it. To your point, it's no longer a mixed bag. This was weak numbers. And in particular, the data actually would have been even weaker if it wasn't for their exports to Russia. And we all know what that's about. If you actually read through, exports to the US were down around 18%. Over 25% down to the EU. And that is everything really significant because now we're seeing perhaps an area that we thought was going to carry us forward and be particularly coming out of COVID. They were later to do so than other areas around the globe that's now stumbling. And I think the bigger picture, particularly when we have all these headwinds out there economically, it does begin to make a lot less sense of how the equity market can continue to power through. And right now, futures look like they're about to be positive again.
Their own government has a GDP growth target, I believe, about 5% this year. So what does this mean in terms of tracking towards that, as some would say, conservative target?
Yeah, no, that's certainly a lot different than the double-digit growth that I think many became accustomed to. What's interesting, though, today is that we are hearing reports of state-owned banks beginning to cut rates to try to stimulate the economy. And I think this is the same as we've seen other economies. The Chinese government is seemingly a bit between kind of the rock and a hard place here, is that you don't want to overstimulate, but at this point, it seems like they're going to need to go down that direction, particularly if Europe and U.S. are slowing down.
We've talked to a lot of investors who are looking outside of the U.S. for investment ideas. And I think you more concentrate on the U.S., if I'm not mistaken. But, you know, how are you thinking about that sort of global allocation and how it relates to how much people are going to be investing in the U.S.?
Well, you're absolutely right. So there's really, I think, a few points here. One is heading into the year, it did seem like Europe and non-U.S. actually exposures were significantly more attractive than they had been in years. We know, particularly Europe, and to some extent, the emerging markets have been unbelievably attractive from a valuation standpoint. But as we know, markets can be cheap for a long time. You recently were talking about Japan, which was a market that for many, many years, the cheapest on price to book, price to earnings, anything, but there was no catalyst. They have a bit of a catalyst now with some corporate reforms, but other markets, it's getting a bit more challenging. So the earnings growth was there, particularly in Europe. On the luxury side, those companies were some of the leaders there. Just like it's been tech leading in the US, it's been luxury leading in Europe. So investors began to flock there. I still think there's a big structural underweight to non-US stocks. We have led for so long. The idea of diversification gets harder and harder, right? If you're continuing to rebalance into an area that underperforms, that gets tricky to do. With that being said, I think it is important, of course, over the long term to have broad-based global exposure. It's not just about the US. But yeah, I think if you're not having China kind of power forward that part of the portfolio, which it had been really for many years, it does get difficult to continue to make those decisions.
And we had already seen the IMF kind of put forward their targets for global growth for this year, with China and India really powering much of that. If we did continue to see weakness in some of the data coming out of China, how should investors be repositioning? Is there a trade that they should kind of be keeping in the back of their heads as they think about some of the weaker data that's come out of China recently?
Well, yes, to me it's interesting because all roads then lead back to the US, right? So it used to be an environment of TINA, meaning there is no alternative to stocks. Yeah. Now within equities, there becomes almost no alternative to the US. And if we look at where valuations are, particularly of some of the tech names, it gets hard. You have to kind of hold your nose and say, I'm buying a stock that trades at this much, not even price to earnings, price to revenue of 30 times or 20 times, what have you. They're not necessarily inexpensive. But where's the earnings growth coming from? It does certainly continually seem to be the US. So even though, again, things were lining up to be a bit better, if this economic data and weakness continues out of China, the interconnectedness, of course, with economies like Germany and France in Europe, it gets a bit more murky of exactly how you would think about where your allocations should be. So I am not necessarily thinking that the opportunity in China is actually going to get much greater until we start to see some more clarity on data like the exports growth.
Sounds good. Well, I mean, of course, a lot to continue to track going forward here. Stay with us, David, for a hot second here. The market melt-up, that is persisting. And if yesterday is any indication, it may even be broadening here. As we inch closer toward a bull market in the S&P 500, the rise is still riding on a select few star tech stocks. The question on everyone's mind, what's the Fed going to do at next week's meeting? So traders, they're favoring a pause, but next week's CPI report ahead of the decision, that could change that. We're back with Dave Mazza, who is the Round Hill Investments Chief Strategy Officer here. So first, to set the stage, what do you believe the Fed will do at next week's or at their next meeting?
So we know we're in a quiet period here. So we're not going to hear any more from officials until the meeting. But it seemed as though at the end of last week, they were really trying to guide us toward the pause in June. Now, there is strong opinions from economists, from strategists, that people are still saying they should do 50 basis points. Yeah. Others are saying do nothing. I do think it's likely prudent, and I think what we are going to see is the pause here. Right. But that sets up July. Now we have, and these numbers can be very variable, looking at data from the CME on sort of predicting where traders are positioning for the Fed meeting. July looks like it's in play now. Which is interesting. So until we see employment start to come down, and this is crazy to say, right? We want worse jobs. Yeah. But until we see that, it's really hard for them to take their foot off of the accelerator significantly. Yeah. But we have baked in a ton of interest rate hikes in an extremely short period of time. Yeah. And so we can't ignore that and its impact to markets.
Yeah. When we talk about the market melt-up, too, as we have been during the past few days, one of the things sort of implied in that is that the market's going up despite maybe lack of catalysts or despite maybe great headlines. And so can it keep doing that, I guess is the question.
Well, again, this can sometimes seem crazy to think about. But we also know there's so much cash on the sidelines. And I kind of hate that term because what does that really mean, right? Are you actually invested or not? But what we do know is there's a significant amount of money that moved into money market funds because cash was the only asset, was becoming to be the only asset that was earning an actual return last year. And again, because rates rose so much. But I actually think we have the potential for that money to move out of cash and move back into equities. And we actually may be at the start of one of the greatest FOMO trades that we've ever seen. Now, that could change in a heartbeat because there's just so many conflicting signals out there. But we do know that people really positioned and bought bonds and bought cash for the first time in a long time because it was attractive. But if you keep seeing the Nasdaq's now in a bull market, I've been missing out. It gets really hard not to say I want to participate in that.
Is there a specific set of companies that continue to drive the majority of that then going forward?
Well, what's fascinating, and we've seen it, the big seven, right? So your FANG or FANGM plus NVIDIA and Tesla, we know that their contribution to index returns, whether it's S&P 500, NASDAQ, has been remarkable. But if we take a step back, again, they are not inexpensive. I think it would be hard to bring someone on here and say that they are, but I'm sure someone out there believes that. But regardless, they are powering the economy. That's where the earnings growth continues to be, particularly if you think about in the back half of the year into 2024, where some question marks remain. So I actually think we're going to maintain this concentration. We did see some broadening out yesterday. Financials actually got back into the action for the first time. But broadly, I actually think we're going to see this idea of the haves and have-nots economy, haves and have-nots market continue to play out. And by that, I mean the haves are the mega cap growth names.
Yeah, I mean, and I keep watching the S&P versus the S&P equal weight like a hawk to see if we're going to get maybe a little bit of gaining in the equal weight index to show that broadening out. Dave, stick around because we want to turn to another topic as well that's sort of related to this, if you would. And we're talking about Apple debuting its Vision Pro headset on Monday. We've been talking about that all week during its Worldwide Developers Conference. It's no secret the tech giant has been looking to compete with Meta over its VR and AR headsets. It's all the buzz. Maybe it's reigniting the metaverse trade. So let's get back to David Mazza, Roundhill Investments Chief Strategy Officer, because you guys have a Meta ETF, right? That initially got a lot of attention last year when it was launched, when Meta was changing its name, and when there was all this discussion in the metaverse. The metaverse discussion died down, but what happened ahead of and around now this Apple event?
So this is fascinating. So yes, so Roundhill has the largest metaverse ETF, ticker METV. It's been around prior to Meta actually changing their name to Meta, or I should say Facebook changing their name to Meta. But what's interesting is that last week, heading into this Apple event, was the first time that we saw an inflow into that fund in well over a year. So investors were staying away. I think people did plow into the space with hopes that metaverse was going to be this next great disruptor and it was going to come much sooner than I think folks perhaps expected. I think the reality set in, particularly with Mark Zuckerberg famously now coming out and saying that this was going to be the year of efficiency with cost cuts and really making the harder decisions to have that growth going forward. But now Apple, they didn't really mention the word, right? We didn't expect them to either. Right. But the idea that you can now have this augmented reality, and I think it's probably difficult to think everyone's going to go out and buy $3,500 glasses. But what the technology that they showed on Monday was really good. Now, people maybe are hoping to jump into what that would look like 20 years in the future. But from what we've even seen in the last year, the work that was put into those goggles says that, hey, maybe this idea of AI, the metaverse, this tech disruption could be actually happening sooner than later.
Talk about some of the weighting, even as you're tracking the different players within the metaverse, because if we're tracking generative AI, everyone has kind of pointed their attention towards chips right now to say that's the interim and near-term winner as demand builds. Are chips still the winner as the metaverse still tries to find legs right now?
Yeah, so it's interesting. And we actually have a generative AI ETF too. The ticker is CHAT, chat. And so the way I think about this is that many people are saying, is it either AI or metaverse? They're interconnected. And one of the main ways they are is through semiconductors, through chips. And the leaders there, of course, are NVIDIA, AMD, and others that are providing these proverbial picks and shovels to make this all happen. And the processing power that exists now coming out of GPUs that NVIDIA has is remarkable. And that allows, I think, generative AI to happen today, where you don't need a device. You just need a smartphone or a computer, and anyone can use ChatGPT and other services like that, essentially for free. But that also doesn't preclude the fact that something like the metaverse, which has this longer term disruption to kind of augment our reality, can also occur too.
So I guess the next question is to refer back to something you said earlier, the FOMO trade, right? That this could be the beginning of this great FOMO trade. How much of that is driven by this generative AI? I mean, this is basically another way of asking the question that we've been discussing for weeks now, which is, are we seeing a bubble, either early stage or full-fledged, in some of these stocks? Or are people going to get burned for chasing the FOMO in this area in particular?
Yeah, it's always hard to say. Now, Bank of America came out a few weeks ago and did identify it as a baby bubble, which is the first time I've heard that term, right? So a new one for our moniker. But there may be some truth to that, right? If we're saying that folks are now going to perhaps pile away from cash into equities, that is going to drive up valuations. But what I think is really fascinating about, again, generative AI is that we're not talking about, again, something that it could be happening 30 years from now, and you want to put your money behind it and because you believe that it's disruptive. This is occurring today, right? Enterprises are integrating AI and generative AI into their operations very quickly, helping boost productivity. Consumers are beginning to use it. You know, we have a total addressable market on enterprise software alone of 120 billion. Which is a pretty big number, and that's in 10 years, to be fair. But the assumptions to get there are not crazy. It's basically just saying if a few more people start integrating it into their workflows, which we're starting to see, then you're going to start seeing those productivity gains, and you're going to start seeing the growth of that space. So again, if we continue to see the inflows and the pace that we're seeing for months and months and months, yeah, we're probably going to get a bit overstretched. But for now, the earnings are there, right? NVIDIA's numbers and their guidance were remarkable, and I think we can't ignore that.
What would you look for in the consumer environment to say that the valuations are eventually substantiated in some of the more cutting-edge technologies that the technology companies are putting forward right now?
Yeah, so the way I think about it is sort of classic sort of valuation discussion, right? So we know that if a company's trading at X number, let's call it 20 for example, of earnings, they need to perhaps grow into that if their earnings aren't there now. What I think is interesting though about this space is that there's been so much attention on the big names, right? NVIDIA in particular. But if you go down a layer, there are companies that perhaps are not as well known. They could be based in China or something, SenseTime, iFlyTech. They have their own, for example, they have their own large language models. They have their own AI services that they're selling into companies, right? And so consumers can use it and companies can use it. And that's why I think there's so much excitement about it.
Yeah, just real quickly, I noticed in your ETF also a company that we just interviewed recently, which is NICE, which does, remember the customer support chats, and they're now integrating some of these capabilities. So I guess there's a lot of different ways that it's going to play out.
That was a fun conversation last week, for sure. Dave, stick with us for a hot second here. A big merger rocked the golf world yesterday after Saudi-backed LIV Golf and the PGA Tour announced their newly formed identity to unify golf, sending shares of stocks like Topgolf, Callaway brands higher, and ultimately reducing competition in the world of professional golf. But what does this mean for investors and how they view market competition? So back with us is David Mazza, who is the Roundhill Investments Chief Strategy Officer here. And some of the crux of this was kind of applying this type of merger and essentially now golf monopoly, if you're looking across some of the different leagues and how they've come together. Where there once was competition, there is no more. So that's good for, I guess, everybody around the sport in some fashion or another. There are a lot of questions that still linger around it, but how do we apply that to what already exists in the business world too, where when there is less competition and that competition falls out, how does that benefit some of the other players that investors might look at?
Yeah, no, I think this is interesting. Yeah, we could probably spend, and I'm sure there will be networks spending hours and days talking about this merger because there's a lot of juice behind it, right? And I'm sure we'll be hearing more about it. But to apply it to markets, and I know you all were speaking about that today in the newsletter. It goes back to the thesis that I've been thinking about, this that I mentioned a moment ago, this haves and have-nots, is that we are seeing either through mergers or just general sort of monopolies that there is a smaller and smaller handful of companies that are gobbling up everything. We know that there used to be significantly more publicly traded companies to begin with. The number of companies has gone down by thousands over recent decades. Many of those probably were smaller, unprofitable companies that people shouldn't have been touching anyway, but that was a way for companies to raise capital. Now, you go to venture capital, private equity, you don't necessarily have to go to the public markets. And when we see a company like, whether it's Alphabet, Apple, Microsoft, and we can name a handful more, they touch so many different areas. And we forget sometimes, I think, that these companies own other companies, right? They used to be standalones, and now they're owned by someone else.
Right.
And there's benefits to that, right? So you can have synergies with that service model. And again, to me, that's one of the reasons why. And it's always challenging to say this time is different, but there has been some structural change that has occurred, right? So if we compare this environment to the tech bubble or other periods, what's different now is that the largest companies are extremely profitable. They have extremely high revenues, and they're growing those revenues often from smaller portions of smaller investments that they own, whether it's Alphabet and YouTube. That's a prime example. And you could go on, metaverse and Instagram, right? We could go through a laundry list of these, but there's some truth to all of this, that these kind of single companies have all these different platforms. And the same's happening actually in markets like China too, which is interesting.
Well, and the other interesting part is, whereas in past eras, even though this administration is seen as being fairly active on the antitrust front, when you're talking about these largest companies, there's more rhetoric than action. In other words, there don't seem to be real concrete regulatory threats to the absolute domination of those companies, right?
Yeah, no, I think there's a lot of chatter. I think there was expectations heading into this administration that there would be, some breakup fears or other things of that nature. I think there's been a crypto crackdown, as we know.
Well, and they've been challenging pending deals, right?
Correct, exactly.
But not things that have necessarily already happened.
Yeah, and so when these mergers happened 10 years ago, 5 years ago, now we're actually just beginning to see how they're playing out. And so it is difficult to go in and start saying we're going to break companies up. What I think is interesting, that's not a ton of attention is being paid on, is just how different the regulatory environment is with the US and with Europe, especially around things like social media and now generative AI. And that's one of the reasons why we're seeing companies voluntarily put their CEOs and other C-suite executives in front of Congress and saying, regulate us, please, because you'd prefer to be regulated on your home turf than you would necessarily in Europe, where you have less influence and control.
Yeah, or as we saw, GDPR.
GDPR, yeah.
Thank you, and how that started in Europe and then came here. So they got a little practice before they had to enact it all here in the U.S. Dave, great to see you. Thanks for coming to visit us. David Mazza, Roundhill Investments Chief Strategy Officer. Appreciate your time this morning. Well, a little breaking news for you this morning. The tumult at CNN taking another turn. Various reports say CEO Chris Licht is out of that job. It comes after widespread criticism after a town hall with Donald Trump and a scathing article in The Atlantic. He had held that job for just over a year. The report suggests that top executive Amy Antelis will step in, at least until Warner Brothers Discovery CEO David Zaslav chooses a new leader. We have been discussing this in recent days. Spoke to an analyst who said it doesn't seem like the turmoil there is having a material effect on the broader company, at least not for the moment. Coming up, investors are not eating up those Campbell Soup earnings with the stock slumping in pre-market trading. We're going to break down that and some other top movers next. Ahead of the opening bell, we got some movers for you. Shares of contemporary Amperex technology, also known as cattle, they fell in the Chinese trading after Morgan Stanley slashed its rating to underweight on fears that Tesla will leave the battery maker in the dust. It comes as the Model 3 is now eligible for the $7,500 tax credit in the U.S., and there are implications for some requirements attached to that credit. Yahoo Finance's Pras Subramanian is here to explain. So Pras, good news, I guess, for Tesla, wannabe Tesla buyers in the U.S., but not great news for cattle.
Yeah, some concern here for cattle or CATL. China is a big LFP battery maker, makes batteries for many automakers. The news yesterday was Tesla's cheapest Model 3 now qualifies for the full EV tax credit. Tesla had used CATL battery cells in the past for the base Model 3. It seems Tesla must have updated where the battery minerals are coming from or increased the value of North American components, which sort of make up how you get the full credit. So we don't know what happened because neither Tesla nor the U.S. government said exactly how they got that tax credit. But it's definitely true that some different batteries are being used here. So Morgan Stanley concerned that automakers in the U.S. will use North American battery makers and joint ventures more along the lines of, let's say, LG and GM and Tesla and Panasonic to take advantage of those government incentives. But we did see Ford sign a deal with CATL, this licensed tech, and make batteries here in the U.S. and Michigan. So they do have some options here beyond Chinese manufacturing.
And Pras, while we have you, there's also some recent, of course, new pricing changes when it comes to Tesla in select states. What do we know about how they're trying to continue to kind of bring down the pricing based on tax credits?
Yeah, and I wrote about this yesterday. So that really interesting stuff here. So that Model 3 now, that base version, right, is qualifies for that full $7,500 tax credit. But now, if you go in states like California, they have their own $7,500 tax credit. So that brings that base Model 3 down to around $26,000. Add in other incentives that Tesla is using on a regional basis. In California, for instance, there's a $2,000 incentive there. You can get a car for around $23,000, a brand new Tesla Model 3. So a big deal there for some buyers, especially in California for the Model 3.
Yes, indeed. And it looks like, by the way, that Tesla is making new highs for the year here, had a recent surge that is continuing today. Just checking to see how many days in a row Tesla's been up. 1, 2, 3, 4, 5, 6, 7, 8 sessions in a row going into today's session that Tesla's been on the rise. So we'll see if it continues. Pras, thanks a lot. Appreciate it. We got to take the opening bell now on Wall Street and take a quick check on the markets as we get underway here this morning. It looks like we might have a slightly higher open for the major averages here. We'll see if Tesla, among others, can continue that run that we have seen, which again has been 8 sessions in a row here. So watching the opening bell here this morning, and a little bit of a gain here, but the Nasdaq is outpacing the other major averages. And it does look like Tesla is participating as I check here on my Yahoo Finance platform to see what's going on. Brad, what are you seeing over there at the Interactive?
I got a whole full screen of that Yahoo Finance platform there. Here at the Interactive, taking a look at the major averages. As you mentioned, we're up across the board right now. The Dow is flat, just barely to the upside by the hair of its chinny chin chin. We'll take a look at the chart here. We'll put that on a 3-day view as we're on this hump day. Taking a look at the Dow, yeah, there you're seeing that bit of green. Nasdaq Composite, fractional gains there. That's up 0.3%, a little more than 0.5% over the course of this week. And then also seeing fractional gains over the course of this week for the S&P 500 and also to start off today's trading session. Let's take a look at some of the S&P 500 sectors here as we do to kick off every day. Taking a look at the 11 S&P 500 sectors, you've got consumer discretionary actually leading the pack. That's up 0.75% right now here. Let's take a look at the year to date just to see how that's continued to move. Wow, year to date up by about 24% for consumer discretionary. Of course, one of the hardest hit sectors over the course of last year with and alongside technology. Technology seeing some gains today. That's up by about 0.2%. Staples, though, on the other side of that, you're seeing a decline there. Downward facing dog, it's lower by about 0.75%. And then additionally, you've got the Nasdaq Composite Tech Heavy Average. Taking a look at some of those mega cap tech stocks. Tesla, who we were just talking about a moment ago, they're up now to start trading by about 3%. You've got Nvidia that continues to remain in focus among investors. That's up by about 1.4%. We'll continue to track that price action as well, still hovering in the the ballpark of the $1 trillion club. We'll see if it can get back into and sustain that particular market cap valuation. And then some of the other $1 trillion players that are already out there among mega cap tech stocks. You're seeing a little bit of movement downward from Microsoft. That's lower by about 0.1%. I've also got some of the golf companies on my mind this morning.
Yeah.
Checked just before I came over here. You've still got companies like Topgolf, Callaway Brands. That was higher coming into the start of today's trading activity. Companies like Acushnet, which of course the parent company of Titleist, that too was moving higher in pre-market. So we'll continue to watch those off of the LIV and PGA Tour deal that came to fruition, with much more fireworks still set to come later on today. I think Rory McIlroy, he's playing in a round this morning in a Pro-Am, and he's set to make a media appearance. We'll see.
Yes, we'll see if he
how
has
that goes.
anything to say.
Yeah.
I wonder what percentage of your brain at all times is devoted to golf. I imagine there's like a little corner that's always just on golf.
You know, usually on days that end in Y, it's about 85 to 87%.
Wow.
Yeah.
Okay.
Heavy allocation.
All right. I know I can always ask Brad about golf then. What about soup, though? I don't know. Campbell Soup stock dipping today after fiscal year earnings guidance fell below Wall Street expectations. The shares down 8%. The packaged food company's report shows that consumers may be balking at recent price hikes and turning to private label soups instead. Imagine that. I mean, it's not soup season per se, unless you're going for a nice gazpacho, which I don't believe comes in a can. Last time I checked, unless you're just not heating the classic tomato soup
just pouring it out the can.
from Campbell. But as I look at, among other things, the forecast that the company's coming out with for the full year, it is unchanged. And analysts were hoping for a little bit more on that front. So that's another thing that's not helping matters this morning.
Yeah, I was tracking this one pre-market as well. I mean, this is a company that allocates about 5 to 7% of my brain. Good Camden, New Jersey-based company. And I think for what we have seen them cite in this most recent quarter, it was some of the product mix as well. The company's CEO saying that the year-to-date results and execution give them confidence in the ability to deliver on their full-year guidance. So that a good thing, perhaps, that investors can try to hold fast to, with adjusted EPS tracking currently towards the upper end of their guidance range here. But it was particularly interesting to note some of the areas where they did see some of the volume mix shifts, and that I think some of the investors might have been latching onto, as well as the margins, the gross profit margin. That saw some slippage year over year in comps as well.
Yeah.
Also, our Brian Sazi, he's going to be talking to Campbell Soup Company CEO Mark Klaus. That's tomorrow, 9:35 a.m. Eastern Time. We're going to have all of that discussion, plus the results, the state of the consumer, and much more. And perhaps we'll put the gazpacho question to him as well. Why not?
Sure.
Netflix. Who doesn't like to watch Netflix and get a good gazpacho going? They're getting some love today with JP Morgan raising its price target on the stock to $470 from $380. Wells Fargo also raised its target price to $500 from $400. You can see shares of the streamer popping on that news. JP Morgan analysts saying that the streamer's paid sharing program will boost revenue over the next few years. Shares higher off of this report by about 4.5% here as we begin trade this morning.
Yeah, this seems to have to do with the new ad-supported tier. I'm just looking at the Wells Fargo note here, which cites that and talks about brands hooked on linear, that they like the ad. Basically, they like the ad platform here. They talked about how many impressions those ads are creating for these advertisers. And they also said they're paying far higher for sports and primetime for a mix of quality and quantity. So basically, it seems like that this is going to be, in the eyes of the Wells Fargo analyst, as well as JP Morgan, who's making similar comments, that ad-supported tier is really going to be a win for Netflix.
Yeah, the JP Morgan commentary and the remodeling of how they're looking at that ad-supported tier as well. They're essentially looking for Netflix to be able to cash in on 100 million borrowers of its borrowers there, and also expecting to see 14 million by the end of this year, 26 million at end of 2024, and then by the end of 2025, 33 million there. So that modeling is going to be interesting to see how that comes to fruition from JP Morgan's side. But of course, that would perhaps create some greater margins and revenue growth for the company as well.
Yes.
Also, let's talk a little Coinbase this
Let's
morning.
do it.
Yeah.
All right. Go ahead.
It's you or me. Coinbase stock extending declines after the SEC filed a lawsuit against crypto exchange accusing it of violating securities laws despite turning other investors away. Cathie Wood's ARK has picked up over $20 million in shares in the last 24 hours. And our next guest seems to be on the same page. In a note, she says the pullback could be an attractive entry point for some investors. Joining us now is Lisa Ellis, MoffettNathanson partner and senior equity analyst. Lisa, great to have you here with us this morning. Always a pleasure to get your insights around this space. So what makes it an attractive entry point?
Well, look, this is a necessary step that the industry has been waiting for. We've needed regulatory clarity in the United States, for many years now. And it's been, the SEC in some ways has been sort of holding the industry hostage over the last year and a half by sort of trickling out these enforcement actions, but not having a constructive dialogue about what issues they're really concerned about or not, and kind of narrowing that and moving it forward in terms of establishing the right set of regulations. And Coinbase in particular, struggles with this, or has struggled with this, because they operate as a regulated entity and have tried to be a leader in the industry, engaging very constructively with the SEC. Now, it's been evident for a year now that the SEC was, preferring to go down the enforcement path. Okay, fine, it is what it is. But there's sort of been this waiting for the shoe to drop, so to speak, for months and months now. And now at least we know what the SEC, is focused on. And I was pleasantly surprised actually by how narrow and specific it is. It really gets down to the exact questions Coinbase has been asking about how to exactly define securities in the digital asset world. And now this, while not ideal ever, of course, to have a lawsuit with the SEC at least provides a path for finally getting clarity on that. In addition, there are several bills that are fairly advanced in Congress to establish more regulatory clarity over exactly who's got purview for what. And I think that these, recent SEC actions will accelerate the timeline in which we'll actually get the congressional support and clarity, which is a really critical step that the industry's been looking for. So, we're not out of the water. There's still a lot of uncertainty, but at least it's a step moving along the path to a point of clarity for this industry.
Lisa, I got to ask though, but isn't the clarity that effectively Coinbase is, a lot of its business in the U.S. is just going to stop because of that clarity? If they can't deal in these various tokens within the confines of the U.S.?
Well, that's not clear. Obviously, they put their own very rigorous test to these things. And the CFTC, of course, has also come out with directly conflicting statements with the SEC. It's sort of a turf war and sort of theoretical debate. But no, just more from a quantitative perspective, 55% of Coinbase's volumes are Bitcoin and Ethereum. Those are definitively not considered securities. That's over half their volume.
How much of their revenue and profits, though?
Overweight, because a lot of that's their lucrative consumers like, you and me that probably just buy a few tokens here and there and pay very high yields on spreads on those. So it's, if anything, punches above weight on terms of revenues and profits. And then a lot of their S&S revenues, which are now 30 or 40% of the revenues in any given quarter, their subscription and services revenues, the non-trading revenues, with the exception of staking, which has always been controversial, but is only 3% of net revenue. The other S&S, which a lot of that is interest on stable coins and other types of, generating interest, essentially, was not under scrutiny. So, truly, 13 coins out of 260 on the platform are under scrutiny, and the staking, business. We don't know exactly how much of their revenue and profit all that is, but it's certainly no more than 5 to 10%, maybe even less than that. And if it came to it, now they're obviously planning to just simply continue to operate as they are while they sort of wait for this to get resolved. They have certainly delisted tokens in the past, like XRP, when XRP came under scrutiny. So it wouldn't be that they would shut down the business. They would just simply delist 13 tokens out of 260 on the platform, right, for a period of time while this is getting sorted out. So look, it's not pleasant. They didn't want enforcement action. They've been very proactive with the SEC, but at least it moves us forward in some way.
What does this do to sentiment around crypto as a whole right now, Lisa?
Well, there's some level of sentiment in the context that it's already been in the toilet, right, for the last year.
An ice age, to put it euphemistically.
There has been an increased level of frustration around this kind of what I would call impasse. That's probably a good word for it. Impasse in the U.S. on the regulatory front, with the SEC over here chirping, the CFTC saying a conflicting thing, Congress, putting bills forward, pulling them back, right? Meanwhile, the EU has put forth very constructive, clear, comprehensive legislation, as have about 30 other jurisdictions around the world. So Coinbase, like many other U.S. crypto companies that we do not want as Americans moving out of this country, have been starting to invest out of necessity in areas like Europe, or Hong Kong, Singapore, where there's regulations. So there's been an increase, you can probably hear it in my voice too, right? Frustration with this log jam that at least maybe perhaps so some level of sort of, pained relief that maybe this log jam will start to clear, and that over the long term we'll finally get to a clear and constructive regulatory regime. In the meantime, we've got a little bit of an odd push-pull with volumes in crypto land, which I think we'll have to see how it shakes out, because of course, understandably, there will be some investors that'll just sort of pull back on any crypto activity for a period of time while they watch how this plays out. On the other hand, Binance, that SEC lawsuit that was filed on Monday is far more broad sweeping and egregious, and has been a much, much needed thing in the industry, because Binance is one of these dodgy, unregulated offshore exchanges that gives the entire industry a bad name, but has had a huge amount of volume. And so with Binance now really under the microscope, that would naturally shift some amount of volume to the onshore exchanges, including Coinbase. So we're sort of TBD. I'm sure there'll be a period where things kind of go quiet. But I mean, the industry's already been very quiet now for a year, and the companies have demonstrated their ability to kind of, slow down bring down their expenses, slow down their investments to kind of, wait this out. And we'll continue to see that happening.
Lisa, while we have you, I'm going to end on a fun curveball note, because I see the golf book always behind and on the mantle behind you. We see it, and I've been dying to ask you as well, because I don't know if you're as flabbergasted as I, but just following this PGA LIV deal, I mean, any thoughts on it, the golf fan that you are?
You're right. I am a big golfer, yes, hence the book in the background. I was as shocked as the rest of the world yesterday. I still have to say I don't fully understand. I mean, I get that there was a lot of litigation and that there's this constructive perspective of like avoiding a lot of just ongoing nastiness and legal fees and trying to come to a constructive outcome. But I really do not understand either the process by which this happened or the premise of it, especially given that the tours were already under a bit of regulatory scrutiny for antitrust related issues. This seems to only potentially exacerbate that. And then of course, there's the whole sort of philosophical thing about the sports washing and whatnot. So I am still flabbergasted.
Lisa, as a fan, are you going to watch? You're not going to stop watching golf, I assume.
I'm a huge fan. I watch all the time. I love good golf. I will be happy if this sort of narrative, can settle its way down and we can just sort of get back to focusing on the really good players and having all the really good players playing in the same forum. And of course, I'll still watch, and but I'm a huge fan of folks like Rory and John Rahm, who have stuck with the tour through all of this. And I care a lot for them personally, that they personally come out of this in, with it being a positive for them personally, who really went out on a limb and passed up huge amounts of money in support of the tour. So yeah, I feel like it's that group of individuals in particular that this kind of comes across as a bit of a slap in the face. But who knows? We don't really know what's going on behind the scenes. Maybe there's more to it that we don't understand that'll come out, I'm sure, in the coming days.
Lisa, I knew that you would be as impassioned, if not more than I, on this. I've been trying to figure out a way to weave it in.
Right.
Exactly. My goodness. All
He's
right.
trying to weave it into every discussion that we have
Seriously.
today, basically.
But I have to say, yesterday morning, right, I'm standing in the hallway dealing with trying to triage the Coinbase SEC thing, and then someone jumps up and says, "Live in the PGA are emerging." And I'm like, wait, what?
What a time to be alive. Lisa Ellis, MoffettNathanson partner and senior equity analyst. Thanks so much, Lisa. We appreciate the time as always.
Thanks, guys.
Yeah. Guys, coming up, a new Prudential survey has the lay of the retirement landscape for Gen X. Economic challenges and savings habits make the outlook pretty bleak. But fret not, we've got more on how they can still make retirement possible. Welcome back. As the S&P 500 continues to swell on the back of big tech, the small cap Russell 200 index is playing catch up. Well, the Russell 2000, we should note, is there on your screen. Yahoo Finance's Jared Blickery. He's got more. He joins us now from the floor of the New York Stock Exchange. Hey, Jared.
Hey, Brad, I know the trend has been toward fewer and fewer tickers and listings over time, but if we ever get to the Russell 200, I'm going to have to do something drastic. I do want to talk about the small caps because they have perked up in a big way. Not only yesterday, but it started last Friday. That's when we had the non-farm payrolls beat. Some would call it a Goldilocks report. I don't know about that. But since then, we've seen risk markets explode to the upside, and in a very important and market different way than we saw earlier, which is the Dow is leading, we've had small caps leading, and we've had the Nasdaq severely lagging. I went back in time, and I'm going to be writing about this in the morning brief for tomorrow. I went back in time and looked at the instances when we've seen this kind of outperformance by small caps on a very short-term basis, and it has not happened since late 2020. You have to go back to the election. That was when Biden was elected, and we saw that huge infrastructure play. Everybody got excited about that. So is this part of a new trend? Difficult to say, but small caps positioning is very, very much short among the futures crowd, the CTAs, commodity trading advisors. These guys are systematic and they react to price. And small caps, I got to tell you, if they can explode to the upside just a little bit more, you're going to see a huge short covering rally. So I think that's a potential. This isn't a long-term call or anything, but just a potential. One thing that could trip it up is the US dollar index. Small caps in general do not like a dollar trending higher. We just saw the Turkish lira hit a fresh record high against the dollar, which means that the dollar is strengthening. So all of that put together could put a little crimp on the action, but I'm definitely going to be watching the small caps over the next few days, guys.
Yeah, it's a hot topic right now. Thanks a lot, Jared. Appreciate it. Retirement will look different for Gen X. Economic uncertainty, inflation, declining pension plans, and Social Security facing a shrinking trust fund. It's redefining the retirement experience. According to the Bureau of Labor Statistics, the average retiree in the U.S. needs $4,350 to cover monthly expenses. With Social Security payments averaging $1,830, there's a sizable gap between those two that Gen X is going to need to fund themselves, and many aren't prepared. A report out this morning from Prudential shows 67% of Gen Xers have no retirement strategy, and 19% of those folks are not saving at all. Rob Falzon is the vice chair of Prudential Financial. He joined us now with an exclusive check of Gen X's retirement plans. This hits home for me, Rob. I'm in that cohort. I'm a Gen Xer. And these are pretty sobering statistics. And there is still time for people within Gen X to catch up during their working years, but not a heck of a lot. What stood out to you from these findings?
Well, the first thing that stood out is this is the tip of the spear in terms of this is the first generation where the significant majority of the generation is heading into retirement without a defined benefits plan. Instead, they've switched over to a defined contribution plan. As a society, we haven't done a very good job at educating these individuals on what level of assets and composition of assets are going to be required in order to generate a sustainable income through retirement. And so there's a disconnect there, a lack of education, a lack of understanding, and a significantly undersaved population heading into retirement.
And so for a lot of Gen X as well, that has seen the market turn multiple times at this point, for the savings that they've put into their retirement that are pegged to the stock market, how do you go about even starting to advise on where they could potentially make sure that they are better positioned regardless of what the equity markets and savings there may do?
Yeah, so that gets into having a retirement strategy. Core to a retirement strategy is what level of assets and composition, Brad, to your point, do you need at different points in your life? So those, the earlier end, Julie, the earlier end of the Gen X still has time to accumulate savings. And so if you think about equity returns over longer periods of time, probably very appropriate to be more skewed toward getting equities and seeing the returns associated with those. As you're getting near to retirement, obviously de-risking of that portfolio in order to ensure that a downdraft in the market doesn't put your retirement security at risk. And then there are solutions around, guaranteed income associated with pools of assets, like annuitization and otherwise, that individuals can undertake in order to take that market risk out of their own plans and lay it off to a financial provider.
Rob, I also want to talk a little bit more about that gap between what people are going to get from Social Security and what they need to live. Because also in the survey, you found 58% expect to rely on Social Security as their primary source of income. But by the time Gen Xers get to prime retirement age, which will be around, 2033, Social Security isn't going to be paying out 100% of benefits, right? It's estimated it could be something like 77% of benefits. So how do people deal with that uncertainty and filling that gap?
Well, the gap is large. So if you look at Julie, the statistics that you put up, the $2,500 per month gap between average expenses and today's typical Social Security payout on average, that translates into a level of savings. To replace that gap, to fill that gap, would require a level of savings that's, depending on mortality and returns and all sorts of things, it's going to be $300,000-$400,000 that someone would have in order to be able to fill that gap. And a third of Gen X has got $10,000 or less saved. So there's a big delta there, and I think a number of levers individuals would have to pull as a part of that retirement strategy. One is increasing savings today, so a change in lifestyle today in order to be able to preserve a lifestyle post-retirement. And then also a reset of expectations as to the level of spending and lifestyle that you're going to have in retirement. One of the other things that the survey came out with that I thought was quite interesting was the more than half the surveyed population expects to extend their retirement date, and 10% expect never to be able to retire. 40% expect to be working part-time after retirement. I don't know if that qualifies as retirement if you're still working part-time post that date, but those are the sorts of actions that I think individuals are going to have to be contemplating.
I mean, even I plan on picking up a little part-time job at a golf course somewhere. I mean, start a ranger, it's not a bad
Don't ask
job.
me about the golf, Brad. I do not have a view.
That's cool. That's cool. We'll stay away from it today. But while we've got you, Rob, I mean, even as we think about some of the roles and how the employment situation is changing, how people are being compensated, and where that skills gap is, what are the biggest considerations as people are preparing for retirement and the reality of the labor market demand for some of those highest paying jobs?
Yeah, and so it's an interesting intersection of individuals are indicating they need to work longer in order to be able to get to sort of a level of retirement savings. Yet over half the surveyed population indicated some job insecurity, concern about the security of their job. Number one on that was the economy, economic outlook, and what that might do to their job security. But behind that were things around being replaced by other workers, younger workers, cheaper workers, et cetera. When you dig below that, Brad, what I think that's saying is they're concerned about technology and skills that are required in what the work of future is going to look like. And so as individuals are thinking about extending their work life, they're going to need to think about how they invest in and upskilling in order to remain relevant to the workplace. And today we have a gap. There's a reason there's a gap between positions that are open and positions that are filled. Much of that has to do with the reality that the skills needed for many of the positions as the economy is advancing with AI and other technology advancements, the skills are not there in the marketplace. And so there's this high demand for a certain skill level that doesn't exist. Individuals are going to have to figure out how they train themselves in order to position themselves to fill those jobs, or at least have the skills that are going to be required to maintain their jobs as they look to extend that retirement date.
Well, all of this is hopefully an important wake-up call for people, but we'll see what happens. Rob Falzon, it's always great to speak with you. Thanks for spending some time with us this morning. Prudential Financial Vice Chair, thanks.
Thank you, Julie.
Coming up, you might have noticed the New York City skyline looked a lot different yesterday. Well, you couldn't really see it. We'll talk about that next. Harmful smoke is continuing to overtake New York City as the aftermath of Canadian wildfires extends its drift south. New York City now one of the worst places in the world in terms of air pollution at the moment. This as there are more than 400 fires raging north of the border in Canada, smoke drifting southwards. It's affecting lots of Canada as well, affecting lots of the East Coast, but drifting west and south and really spreading over a broad swath of areas. And here in New York City, schools have canceled outdoor activities. That's happened where I live in New Jersey as well, on concern about this harmful air.
Yeah, and a lot of people are getting kind of a crash course on AQI, air quality index here, and it runs essentially, it's a range of 0 to 500. Even I am learning more about this, even as we speak, and the air quality, just looking through some of the areas in New York right now, I mean, they're in ranges of excess of 163 for my friends in Bushwick, Maspeth even seeing 154 right now, and that is in the red category as it would typically be defined. Anything kind of below 50 is where it's a good reading. But right now we are in excess of 150 in some areas in New York.
And what strikes me about this is something that happens in other parts of the world on a relatively regular basis. Right now, actually, the air quality in Beijing is better, considerably better than it is here in the New York area because of this. But this is something that happens on the West Coast because of wildfires. It happens in places like China, happens in places like India. Obviously, this is something that is linked to some degree to climate change, the increase in wildfires, both because of lightning strikes and because of humans setting fires that then get out of control because of dry conditions. My point is, if people who are in positions of power and decision makers experience this more frequently, maybe then something will actually, that will spur some action to address some of these problems in a more profound way.
Sometimes you need to experience it firsthand too.
Maybe so, but I don't think that a couple days is maybe going to move the needle. It would have to happen.
Well, let's hope there are no serious issues or casualties long-term that come about from this. We'll continue to track this and bring any major updates your way. Coming up, though, what our next guest says could be the catalyst that slows down the economy. We'll speak with JP Morgan's Stephanie Roth. That's next.
We're coming up on 10:08 here in New York City. This is Yahoo Finance Live. I'm Julie Hyman with Brad Smith, and we are a little more than 30 minutes into the session. So let's take a look at some of the top movers that we are watching today. Tesla shares pushing higher after news the Model 3 is now eligible for the full tax credit under President Biden's Inflation Reduction Act. It means battery components will need to be majority sourced domestically. How it achieves that could be the next focus for investors. And by the way, the shares are up now 9 sessions in a row.
Wow. We're also watching shares of Stitch Fix, the company saying it's considering exiting the UK in fiscal 2024, saying the macroeconomic environment has changed since coming into the market 4 years ago. Stitch Fix is also cutting back its distribution centers from 5 to 3 in new cost-cutting measures.
And Dave & Buster's also on the move after reporting record revenue for the first quarter, jumping 32% year over year. The chain did see same-store sales decline 4%, but the company's CEO said it's committed to long-term success by repurchasing or authorizing the repurchase of $200 million worth of common stock. Oh, it's done so far in fiscal 2023. The shares are up in today's session.
That's right. Big jump there. Also, as investors shift focus to the Fed's meeting next week, our next guest says that rates are likely to remain restrictive for the rest of the year, but warns there's one catalyst that could slow down the economy. Stephanie Roth, JP Morgan Private Bank Senior Markets Economist, joins us now. Great to have you here in studio with us.
Great to be here.
So what's that one catalyst?
Well, so right now you're seeing rates are in restrictive territory. And most recently, business revenue for the U.S. economy has actually slipped below the Fed funds rates. So what does that actually mean? Business revenue, or if I'm a business and I own a certain company and I'm thinking about investments, if my revenue expectations are lower than what I can get in cash, I'm going to be slowing down my investment. That's likely to really slow down the economy. There's been an underappreciation for the nominal interest rates in this economy, and the fact that that's what needs to really get restrictive. People have been focusing on real rates. It's really more about nominal interest rates. We're a nominal world.
So explain to us what that means for people who don't, nominal interest rates is adjust for inflation, right, is what we're talking about here. So where are we with the nominal rate right now, and where should we be?
Exactly. So nominal interest rates are now sitting at 5%. That's where the Fed funds rate is sitting around. Business revenue, or really GDI, and that's a part of the GDP report that comes out, that slowed to around 4.5%. So now you're at a place where interest rates that you can get on cash are actually below your revenue rate in the economy. So if you're planning ahead, why would you invest that cash if your revenue expectations are potentially below that? And the economic outlook is pretty uncertain.
You're the second person that's brought up GDI this week. The importance of tracking GDI versus GDP. What is that for investors out there?
Sure. So GDP is the measure that many of us look at. It comes out a little bit sooner, and it tracks the spending side of the economy. Sure. How much are businesses and consumers spending? GDI is meant to match that, but it uses a little bit different source data. It measures the income side. How much are businesses bringing in an income? How much are consumer companies bringing in an income? They should match over time, but what's unique is in the first quarter, GDI was a lot weaker than GDP. So it tells you maybe there's some cracks under the surface. Maybe there's some income from the business perspective that's looking a little bit softer. Profits looked a little bit weaker than the GDP data would have suggested. So there's just a bit of that mismatch there, which just gets investors looking at maybe some of the cracks that are hiding underneath the surface.
Well, I think the question here comes back to magnitude, right? Because when you talk about why would I invest the money when interest rates are at this particular level, I mean, companies have been telling us that they're not going to be spending as much, right? They're cutting workers, they're cutting CapEx, this is the year of efficiency, et cetera, et cetera. I guess the question is, how bad is it going to get? Is there indeed going to be a recession this year? How dramatic is it going to be? What are these tea leaves telling you?
Yeah, exactly. And so far, it's been very much at the margin. It's been the big tech companies that have pulled back. now it's likely to be the real economy that's likely to feel it. So the service sector continues to add jobs. You looked in the last payrolls report, jobs that were added were 339,000. So there's still resilience in the real Main Street part of the economy. That's what's likely to slow down and why we do think the economy will slip into recession. Base case is recession hits around the fourth quarter of this year. Hard to get the timing exactly right, but that's our base case expectation. As for the magnitude, I think about it in terms of unemployment rates, just because it's a little bit more tangible. So latest unemployment rate was 3.7%. Think that rises to about 4.5% at the end of this year, and then 5.25% next year. So that's consistent with a run-of-the-mill recession. We're sticking with a sort of normal recession rather than this concept of mild, because that's hard to promise, and it's possible it could be just a more normal type of downturn.
What does that mean for the employment situation as well as investors, well, not even just investors, consumers out there who are trying to remain resilient? They're trying to also grapple with what their prospects for jobs are as well that are going to allow them to outlast the recession.
Yeah, and that's probably going to change at the margin over the course of this year. And that's what the Fed's trying to do. They're trying to slow down the world because they're trying to bring inflation down with it. So to some extent, that's what the aim is. If they weren't able to slow down the economy and bring down inflation, that would be a bigger type of problem. So the Fed is looking for this slowdown, certainly not hoping for a recession by any means, but it's possible a recession will just be needed to get that last bit of inflation back down to closer to the 2%.
We'll see what that looks like, and we'll keep in touch and check on more of these interesting indicators you're looking at. Stephanie, thank you.
Thank you.
Stephanie Roth is JP Morgan Private Bank Senior Markets Economist. Coming up, why commercial real estate might soon be under pressure. Well, a lot of people are saying it is already. We'll give you the details next.
Curious about what's going on in the housing market and whether or not it's a good time to buy this home or another one? We've got you covered. We've got a jam-packed week filled with experts, including real estate agents from across the country. We'll also get a temperature check on the state of home building and whether or not it's a good time to stack up on those home builder stocks. We've heard from home builders that they're capitalizing on the housing shortage. We'll also tap into commercial real estate. Is it doom and gloom after all? And can't forget, we'll hear from the real estate queen herself, Barbara Corcoran. Tune into Yahoo Finance Live all week long.
Following the collapse of Silicon Valley, Signature, and First Republic banks, fear of a collapse in the commercial real estate market has been top of mind. Elon Musk is the most recent prominent voice to express concern, saying in a tweet, commercial real estate is melting down fast. Now, a report from data provider Trepp says that $1.5 trillion in commercial debt could be coming due in the next few years adding to the pressure. Joining us now with more on this is Brian Paskus, reporter at the Commercial Observer, which covers real estate. So you're sitting squarely in the midst of this. And the issue is, as I understand it, is that a lot of loans that people take out, that companies take out, investors take out for commercial real estate are interest only or balloon loans.
Sure.
And so when it comes time to actually pay off the loan, if conditions have changed, if you can't sell your property, if you can't refinance, et cetera, you have a problem. How big is the problem?
It's a big problem. I mean, ultimately, commercial real estate is super interest rate sensitive. And what we've seen is the highest interest rate increase in 40 years engineered by the Federal Reserve. And for the last 15 years, commercial real estate and many other businesses were relatively addicted to low interest rates, and they made their decisions accordingly. So what we had was a recent article in the Wall Street Journal that showed, today 85% of all commercial mortgage-backed security loans are interest-only loans, meaning they were expected to only pay the interest and then they pay the principal off at the end. Well, that equation is radically different than it was in 2010 when 15% of all commercial mortgage-backed security loans were interest-only loans. So it shows you how dependent on low interest rates the sponsors were, the investors were, and the owner of these buildings were. So it's an issue, but I think people need to recognize and take a step back. Commercial real estate is a large industry. I mean, this is an industry that involves industrial storage buildings, it involves multifamily apartments, it involves hospitality, hotels.
I think people picture only office buildings now.
It's not only office buildings. There's office buildings are where the pain is. Retail has seen some pain with e-commerce growing, but there's parts of retail that are becoming, more attractive. But yes, offices are in trouble. There's not much we can do about it, but ultimately, I think the business will evolve and get through it.
One of the other major parts of this that I'm admittedly learning more about is the upcoming maturity wall. What do people need to know about that as it relates to commercial real estate?
So there's 1.5 trillion of maturities on these commercial real estate loans due by the end of 2025. So basically, picture like 500 billion a year is going to need to be paid off, over the next 3 years. And ultimately, the sponsors are going to need to find ways to get equity or debt into their capital stacks to pay off these loans. And what we could count on is, as the banks have kind of pulled back recently with the regional banking crisis, there likely will be more private equity partners entering into the capital stacks of these commercial real estate loans to help these maturities and to get this wall paid off. But not everyone's going to get that money. These are tough negotiations, and some people, some sponsors, some buildings will go under. They'll have to be sent into foreclosure or special servicing. The banks might take over the buildings themselves. There's going to be winners and losers, as there always are in a capitalistic system. But there will be some pain, obviously, because as we said, the interest rate equation changed, and that has caused a lot of disruption and distress in the commercial real estate market.
How much can we tell in advance who the losers are going to be? There's been a lot of discussion about this, about where this stuff is held.
So I think we're already seeing where some losers are, and this is in the public office REIT sector. So you're seeing a lot of headlines about Vornado, SL Green. Their stocks are down, 60, 50, 80%, or it's not 80%, 50, 60% on the year. And this is because these are office-dependent companies that they made the bet. It was a great bet for decades that people will go into work 5 days a week, that these buildings will continue to always have value. They're going to have good rents. They're going to have good tenants that will be able to pay off hundreds of billions of dollars of commercial real estate debt that they take out to purchase these big buildings. Well, now New York City is seeing maybe 56% of employees on a given day of the week come into the office to work. That's not going to
One of those companies owns this very building in which we are sitting right now.
Yeah, any building you could be in could potentially be in a distressed situation. But that doesn't necessarily mean, we're all going to be emptied out in the street.
Right.
You're just going to have to find solutions. You have to find, equity partners to, fill the money you owe on your loan. And that's just what's going to have.
Even for retailers, the construct of how much square footage they want to operate in their own real estate footprint is changing dramatically based on how consumers are engaging with them. What does that kind of spell out as well in the commercial real estate environment going forward?
Well, retail's been under a lot of change and has been, experiencing a metamorphosis since really the turn of the century. We remember, buying eBay 22 years ago, and now Amazon's growing. And what you're going to see though is that there's always going to be room for small business in this economy. You might have the Bed Baths and Beyonds go under. You might see JCPenney's, J.Crew. No longer are people going to be shopping at the malls with these anchor tenants into the future. This isn't 1984 where we're spending all of our day at the mall. We're mostly spending it online. But there is still always a place in most American cities where you're going to want to go out and buy that specialty store. You're going to want to go to, the store that sells furniture because you want to sit in it, you want to buy it, you want to know what it's like. You want to try on clothes, in person. So there's always going to be room for that. It's just not going to be what it was for most of our lives that we've known.
Brian, finally, I want to ask you, you guys have a big conference in the fall, right, that looks at the REIT business.
Yeah.
And I imagine the crux of it is going to be some of the same questions that we're talking about right now.
Yes, well, that's going to be specifically focused on real estate investment trusts, the REITs. Those are modeled on mutual funds, and they are basically companies, corporations that purchase, invest, hold on to large portfolios of real estate assets. And the REIT industry is very large, it's very diverse. It encompasses everything from the 5 major food groups of commercial real estate to data storage, to hospitals, to even timberland. Cutting down trees and storing that. There's
cell
REITs for that.
towers too.
Cell towers.
Yeah.
The REITs are huge. They're everywhere. This building we're in was likely part of a REIT portfolio. So Commercial Observer is going to be hosting a large conference on October 17th. I'll be there covering it. We will, hopefully be, educating the public on the importance of REITs and how, wide a pool they have in our economy.
Looking forward to much more of that timely information coming forward from you and the team. Brian Pascas, who is the Commercial Observer reporter, joining us here in studio today.
Thanks for having me, guys.
Absolutely. And coming up, everyone, the oil market push-pull continues. Crude now trending higher with Saudi Arabia's pledge to deepen cuts in full view. We discuss the trajectory for prices next. Oil prices pushing higher today as investors weigh the deep output cuts from Saudi Arabia with an unclear economic backdrop. Our next guest says despite the ability for OPEC Plus to tighten balances, it can't change the macro picture. Rebecca Babin, CIBC Private Wealth U.S. Senior Energy Trader, joins us now here live in living color on set. Great to see you.
Thank you so much for having me.
So let's go back to the decision from OPEC Plus and how significant of a decision that was and really setting kind of the framework for now the pricing and how that may move forward from here.
So it was a very significant decision for them to cut 1 million barrels. That is something that typically would have a significant impact on markets. You were talking 5 to 6 to 7% impact in normal environments. 1 million barrels typically is $5 to $7 of Brent or TI pricing. So this wasn't a quantity issue. They came out big, they came out aggressive. The things that are working against it, they said they were going to do it for 1 month and revisit, right? We don't have a long duration on how long they will actually continue these cuts. So that's one thing that kind of took away from the impact. But the bigger, broader picture of why it didn't have the impact is even with those cuts, the focus of every trader and every kind of commodity focused person is on the macro. The granular under the surface data and crude hasn't been horrible. Demand figures, 4-week rolling average of US consumption from the DOE data has been strong, over 9 million barrels a day. So the numbers out of China have been okay, not quite as good as expected, but not as bad as what the market's pricing. It's this macro overhang of, is there going to be a deep recession in the US? Is the entire China recovery going to stall out based on the warning signals of the industrial demand side? So that's why we had a limited kind of response to those cuts.
And I'm just looking at the EIA inventory report because, as you pointed out to us, 10:30 on Wednesdays is when this typically hits from the Energy Information Administration. And we are looking at a drop in crude oil inventories of 452,000 barrels, which I believe was unexpected. Gasoline build bigger than estimated of about 2.7 million barrels. And I know you were looking at what refinery utilization
and implied demand. Yeah.
And implied demand. I'm not seeing implied demand on here, so I'm going to keep looking for that headline. But I mean, I know these numbers are incredibly volatile on a week-to-week basis, but it is interesting to see that drop in crude inventories when a build was expected and a larger than expected build, it looks like in both gasoline and distillates.
So I think people are going to look at that gasoline build pretty closely and the under the surface implied demand factors. There may be some kind of lag as a response to the Memorial Day driving when people filled up their tanks and kind of came back. So I think more importantly than just like the week over week number is that 4-week rolling average of where demand is. The draws in crude, that's somewhat bullish, but I think the meat of the report comes in those product inventories at this point, because we're going into summer driving season, and that's really where you get the pull of that product and starts to rip the commodity kind of higher. So not seeing the numbers, I'd want to see that implied demand and see where that shakes out.
I guess broad strokes, what should travelers be prepared for this summer driving season?
Yeah, great question. So I think you're looking at right now $3.55 on the national average of gasoline prices. I think you're probably going to see that kind of come up to the high 3s, maybe low 4s. The reason I say this is if I look at the forward-looking estimates for where flight demand is going to be over the next 4 weeks. In China, it's up 7%. In the US and Europe, you're going into a very heavy period. You're going to go summer driving season. And I think that's going to absolutely pull the market into a deficit, and you will start to see those gas prices rise.
Aren't those contracts, though, for purchasing from some of the airline operators typically done months in advance of time? So why would that, for my own edification, trickle over into what drivers are experiencing too?
Right. So there is some of that that's kind of set and hedged, but not all of it, right? So if you get this ramp in expectations ramp in demand above those expectations, you see the draws. Not every single gallon is going to be hedged. Right. So it still has a read through. So what you look at to compare that is above seasonal averages. And so when they hedge to a seasonal average and then you go above the seasonal average, you get that pull.
To go back to the macro picture for just a second, and outside of the U.S., we just got that China export data, right, that was disappointing. And of course, that's been a big area of focus and a big swing for what we're going to see for global oil demand. So how are you factoring that into the equation?
So the overnight numbers for China on a macro level were weak. For crude oil, they were up 17% month over month and 12% year over year. The crude import numbers were over 12 million barrels, which is a really strong number. The month prior had been a weak number, and that was mostly due to destocking of their inventories. So again, you have this fight between the macro, the big picture numbers not delivering, but the consumption numbers, gasoline demand in China is delivering. The question is, how long can gasoline either kind of be the outlier? Does industrial drag it lower? Or do you get stimulus out of China, which is probably why crude is up today, on the hopes that those weaker numbers that came out on a big picture level kind of put forth more pressure for them to stimulate, and then you see the reversion in industrial demand higher. So that's the rub.
There's, of course, a large geopolitical overhang when we talk about all of these things, too. How much of that, if we continue to see kind of an extended or long-term amount of uncertainty in the geopolitical situation and agreements more broadly about production and output, how much does that continue to leave prices at elevated levels like we're seeing right now?
The geopolitical picture is always a factor, but it's been a factor for a long time. Sure. There's a lot of reporting right now that there's friction between Saudi Arabia and Russia, right? Russia hasn't delivered its supply cuts as needed. Saudi Arabia just came out and unilaterally cut. So they've made statements that they're going to trust but verify Russia's data, which tells me they're going to apply a little more pressure to Russia. So I think the geopolitical backdrop continues to be supportive of crude, but there's a lot of chatter and a lot of noise about maybe that relationship not being as strong. And if OPEC Plus shows any signs that that relationship is not strong, it will weigh on crude prices. So it's a factor, and it's something that I think traders are definitely watching.
Interesting. Rebecca, thanks for coming in. It's so good to see you in person. Usually you're in Texas, I believe, right?
I'm in New York.
You're in New York?
Far away.
There, I just assumed. You're the second person today who I assumed was in a different state, and instead it's just down the road. So come in more often and see us. Rebecca Babin, CIBC Private Wealth U.S. Senior Energy Trader. Thank you so much. Appreciate it.
Thank you.
Coming up, Kevin O'Leary is weighing in on the SEC's crypto regulation moves and backlash facing Target over its Pride collection. We'll have more on that next.
The SEC suing Coinbase this morning in the Southern District of New York for failing to register its trading platform with the agency, alleging that it was an unregistered national securities exchange, broker, and clearing agency. The SEC also bringing charges against the largest U.S. crypto trading platform for failing to register its crypto asset staking as a service program.
25,000, which is actually a little bit below here, was a floor. That's a big historical area for Bitcoin. It is not yet reclaimed yesterday's high. And so this is factoring also the news we got yesterday from Binance.
Coinbase was involved in staking in general without registering a staking platform with the SEC. In the eyes of the SEC, staking, the action through which proof-of-stake tokens are created, is in itself a means through which securities are created and exchanged. And that really is one of the big questions now with regard to Coinbase is, will it be able to pivot overseas? In the first quarter, the US represented about 86% of Coinbase's net revenue. That is not an easy pivot to execute.
I think the questions out there is what are actually securities and not securities, and do SEC actually creates a pathway and say this is how it should work?
The agency said it's acting as a broker, an exchange, a clearing agency, and also a seller of securities. They say as a result, Coinbase is then evading disclosure laws that were specifically set up to protect consumers by Congress. This is the 14th case that the SEC has brought against crypto entities since January.
Bottom line here is if the SEC doesn't completely shut down Binance and Coinbase, probably not going to derail crypto, but if in fact the Coinbase business model cannot survive with SEC regulation, well, that's a different story altogether.
The SEC asking a judge late yesterday to freeze all assets on Binance's U.S. platform after filing a suit accusing the exchange of improperly handling funds and operating as an unregistered broker. The SEC's actions recently taken against Binance and Coinbase could transform the U.S. crypto market, which is largely operated outside regulation, pushing them to follow the same rules now as traditional stock and bond exchanges. Kevin O'Leary's with us now, O'Leary Ventures chairman, and you've talked a lot about crypto in the past, right? You've had your own challenges, I guess, when it comes to FTX in the past.
I think that's an understatement.
Well, yes. So I guess I'm being diplomatic.
But
to bring it to today, I'm just curious how you're thinking about these latest developments.
I take a different view than others, perhaps, on this. I'm actually happy this is happening because from the potential of this asset class, it has been stymied, it's stuck in the mud, if you want to use those words. It hasn't gone anywhere for 3 years because there has been absolutely zero institutional interest. And so people ask me, well, why is it that Bitcoin, which is probably the best index for crypto valuation, is stuck between 25,000 and 30,000 in perpetuity? Because there's zero institutional interest. And so 97% of all the world's wealth in terms of it being invested is done through sovereign wealth or institutional investors or indexed in the S&P 500, or 60% of the S&P is now ETFs. And none of this is carried in crypto. You don't find crypto anywhere. And so while it's been great to be part of this wonderful nascent community and cheering on this idea of a rogue nation of crypto trading, it's worthless. Because the asset class is a nothing burger today, and it will remain so until we resolve this issue. And so now we go on to this litigation. We've got two major claims here. Binance is completely different than the claims made against Coinbase yesterday. These are two different situations, and they need to be looked at differently. But overall, I welcome it.
So are you then long-term still very bullish cryptocurrency, as we were talking about even last year, and even in this interim period of time during the crypto ice age? How much has that impacted your own holdings? How much have you lost as a result of this interim ice age that we've seen in crypto?
Well, some of my losses had to do with FTX.
Sure.
Basically, all the whatever you want to allege to that, it'll have to go to trial, et cetera. But the asset class itself still has tremendous potential. So what I've done is reestablish our positions up to a 5% weighting. But I also realize at this point that we're going nowhere. We are not going to advance the cause. We're not going to get any capital appreciation. It's just not going to happen until the very first institution calls me up and says we're going to put a 50 basis point weighting in a $100 billion fund.
How does what has been happening clear the path for that? Because it seems what the SEC has effectively done, let's leave Binance to the side for a moment, right? Because there are some Binance-specific issues. They've effectively said all the tokens have to be regulated as securities. Does that sort of then negate the market for tokens in the U.S.? Does it just make Bitcoin valuable? What does this do to the landscape exactly in the wake of this?
Well, let's read the room. Let's go to Coinbase. Let's talk about butting heads for the last 4 years with the regulator. It's now crystal clear what Gensler wants. He is calling it a broker-dealer exchange, period. There's no grayness. Now, if I'm on the board of Coinbase, or I'm a shareholder, which I'm not, and I certainly have almost taken all of our capital out of there, I have zero interest as an institutional investor in putting 1 cent into an exchange, a service, a centralized wallet that is at war with the regulator I serve every day. I have no option but to serve the SEC. If I want to issue securities, I want to participate in financial services, whether I'm here in New York or I'm in Abu Dhabi or London, England, or in Zurich, we all play by those rules. We have for decades. We understand the rules. We built it into our systems. We report to it. There is no optionality there. And then you say, here's an asset class you're interested in investing in, but while you're at it, we're going to war with the SEC. So you can invest with us and we'll go to war. Our fourth battle with the SEC, maybe there's a new idea. Here's a new idea for you. How about swapping out the management of Coinbase, finding a new leader that doesn't want to be Don Quixote in front of windmills and constantly fight a regulator that's told him 3 times no. The answer is no. And I hear it. The rest of the world hears it. but apparently he doesn't. And I hate to be critical,
but
why can't we find a leader that wants to sit down with the staff and Gensler himself and say, okay, worst case, hear me out on this. Let's agree Bitcoin is a security. Let's say USDC is an actual equity that pays a dividend, okay? Let's treat USDC as not a speculative asset, but when it pays yield, that's interest income. If you want to lend a token, that's a dividend. And it's a security. When you up or sell, if you sell it or you don't, or you make money, you don't, that's a long-term or short-term capital gain. What's so wrong with that? Why not agree to that and then have $1 trillion come into the market once you've had that agreement? I'm okay with whacking Brian, he's a great guy, putting someone else in there.
He's a great guy. We can get rid of him, but he's a great guy.
He's a pioneer, but if he worked for me, I'd fire him. I don't want to go to war with Gensler. That's a really bad outcome for me. They've decimated their stock, they've decimated their market cap, and they want to do it again? I mean, that's just insane.
Just to put a fine point on that, you've essentially kind of decreased your positioning or your portfolio weighting of cryptocurrency now from 20%, which is what it was maxed out at last year, down to 5%. That's one technology. Where else within your portfolio are you looking across some of the cutting edge technology, generative AI even right now? Do you chase the FOMO trade in AI?
I don't chase it, but I already own those names. I've owned the semis, I've also owned Microsoft, I've owned Google. These have been names that are part of our portfolio and have been forever as equity. So we've enjoyed this extraordinary run on tech. We have an index that does that. So I'm not worried about that exposure. You're right, we've taken down crypto a lot while we wait out the war. We're at war now. And so Binance is a, I'm actually, it would be great to resolve this. Let the last shoe drop. Binance has that BNB token. If it goes to zero, it's FTX all over again. And once this is over, and once we've agreed that these are securities, and once we've agreed that these are broker-dealers under the same rules that everybody else has to operate, we have a new nascent industry that's going to take off again. This should be considered a rebirth, and I'll take my asset allocation back up to 20% when that occurs. What's wrong with that? I mean, this story's getting boring. It's getting boring. Hey, let's fight the Securities and Exchange Commission one more time. Sure. What a stupid idea.
Yeah. We want to talk about another topic, though, here. When we think about the other areas of the economy that many who we've spoken with on a day-in, day-out basis, they are looking at the Fed and what the Fed's going to do from here and trying to telegraph, Q3 2023 recession. How are you looking at that? How are you trading around that? How do you believe the Fed has done in terms of their own job?
I have to admit, and I've been a Fed watcher, I have to be for my whole career because I'm trying to figure out, like everybody else, what they're going to do with rates. This is an extraordinary situation. We may actually, and I say we as a market, may have actually engineered a soft landing. We have been waiting. This is the most highly anticipated recession that's never appeared. Number two, I think there'll be another 50 basis points of rate hikes to get us kind of into that 5.5 terminal rate, which means money will trade at sort of 7.5% in the best credits, all the way up to 15%. We've had great economies with rates like that in the past. And we are still at full employment. And here's the one challenge. The data hasn't changed on inflation. It's still north of 4%. So if you think the Fed's going to stop, I think you're nuts. They're going to keep going. Another 25 basis point, another 25 basis point after that. And for all the criticism that Powell's taken, he has been a master of guiding this ship to a slowdown that looks like it won't even be a deep recession. Right now it looks like that. And as evidenced by new highs in the market. I mean, are you kidding? This guy should be given an Oscar. I mean, he's done a hell of a good job. And so, yeah, he'll get bashed every day, and that it's political and all the rest. But tell me what he's done wrong as evidenced by where the market is today.
Well, as you say, a lot of people bash him, so they have a lot of things to say about that. But I want to turn to another area of your expertise, which is funding startups. And as you're in your role on Shark Tank, right, in deciding which startups are worth your money. And we thought we would have a fun hypothetical for you. Let's say a company comes to you, maybe it's called Banana, and it says, we have a $3,500 headset, looks like ski goggles that we're going to sell to people. It's going to allow you to do all kinds of cool things with apps and sort of augmented reality. And this is what we're going to be trying to sell to the public. Would you fund that kind of a product?
I was having this exact narrative with my tech son, who's a deep dive techie. And I said, this is absurd. He said, Dad, you once worked for Steve Jobs. I said, that's true, I did. And he told you how many countless times they don't know what they want until you give it to them. And I thought, Trevor, you're right. He did say that. He's always been right that way. And so there's 2 billion cell phone users on the Apple platform right now, 2 billion. All you need is 0.5% to even want to try this $4,000 headset in the context of the platform they're providing, and you've got a monster market. And so in that sense, I think the narrative should be, let's see what happens. But it also buoys a much lesser version at $500 from Meta, which has also been spending billions developing this. Some percentage of the population may not be like you and I. I don't want to wear a computer on my face. That just doesn't turn me on at all. But that doesn't mean I'm the market. But I think about the potential. And if you told me, look, do you want to have a look at a new condo in LA? Just put this headset on for 5 minutes and I'll give you a virtual tour. Or how would you like to have an expert walk you through the new museum in Egypt for King Tut? Instead of flying there, it's a $1.5 billion facility about to open in a few months. I'll give you a tour just for you. Put on this headset. Now you're talking. And I can see that happening. And if you said to me, look, how would you like to market O'Leary Fine Wines and have someone be with you when you're blending?
I can't taste it through the headset, though.
No, but I can taste it for you, and just look, and I certainly know how to do that. And I'm just thinking to myself, yeah, I see that. So there'll be a high-end market that Apple is going to pursue, and there's going to be different tiers, but you need the software platform. But your original question about startups, we're having a real hard time with capital right now. Since I was last here, venture capital's dried up on first rounds. There hasn't been a new deal in 3 months. And there's just no appetite because every VC, including me, is looking at their existing portfolio. We have over 30 companies. We're saying which ones are going to survive, which ones aren't going to make it, where do we put more capital? We're not looking right now, although Shark Tank starts next week and there'll be all kinds of new deals, but I'm licking my chops for this season because the valuations are going to come way down to the 2008 levels when we started this show decades ago. And I think we're going to have a very interesting season.
Just lastly, while we ask you, or while we have you, there's going to be a lot of focus, and there already has been a ton, about what it means to be a purpose-driven business. There's been kind of even more swirling around Disney and their battle with Ron DeSantis, but even more recently, Target and them pulling some items of clothing that had to do with support of LGBTQ plus rights. And for what we've seen with how people are now calling on Target and the business community as a whole to stand firm in their support of the community, I wonder what it means to you for companies to be a purpose-driven business while at the same time understanding the market that they're operating in and still moving forward with the values that they want to convey to consumers and their customers.
Well, you're raising a very good question because it's measured by market capitalization. Let's take the example that started this whole narrative, Bud Light. When you're marketing a beer, you are selling a commodity. Your beer is no different than every other beer except its brand. That's it. And so your job is to take care of your customer, your employees, and ultimately your shareholders or stakeholders that have put up capital to risk it. And you've spent decades building America's beer by spending billions of dollars in advertising. Is it really your job, and I speak to the CEO and then the board above that man or woman, to get involved in educating beer drinkers about gender
was it
identity?
about that, though, or was it about someone on the marketing level actually thinking this would be a good idea and trying to appeal to a different market than traditionally they had appealed to?
Does it?
I mean, you have to tread that line right between you don't want to alienate your existing market. We can argue about why they were alienated, and appealing to a new market. Like, that's a tough line to tread, isn't it?
How about this? You lost me $9 billion. Tread that line. I'm firing your rear end. And that's exactly what happened.
Right.
Because you did not understand your job was to sell a liquid commodity. You did not understand the relationship between that liquid commodity beer. You're selling beer. Your job is not to educate the entire society on gender neutrality or not. That is not your role. Your role is to sell beer. And if you can't sell beer, I think you should be terminated. And that's what I think should happen. $9 billion in people's retirement accounts? That's a lot of money. For what? Why did you do that? And so I think stay in your lane, read the room, understand your mandate, and don't get too far off your primary objective, selling beer. And that also goes to Target, and it goes to everybody else that thinks, well, my job is no longer to take care of just my constituencies, my customers and my employees and my stakeholders. I am going to educate the world.
But it's not. But I think. But it's not just. They're not doing it out of necessarily some sense of altruism.
What are they doing it for? Who are they helping?
It's about brand identity. It's about supporting their employees.
How's that working out?
For a company like Disney, it seems to be working out quite well. I mean, they are supporting their employees. They've had gay days at Walt Disney World in Florida for years, and they have a very loyal employee base. So in some cases, it works quite well.
Wait.
And it worked quite well. If they would have done this 5 years ago, it would have been fine.
What was the name of the last CEO that actually started this mandate? I think I forgot his name already. He's ancient history because he took that company's stock down from, I think, 126 to 90. And that matters too. That's billions of dollars erased because he had well, let's get involved in a huge debate about this. I think Mickey and Minnie want to take care of kids' entertainment. That's their mandate. It's family values. Republicans, gay people, gender neutral people, they all want to go to Disneyland to be entertained, not to be educated on social issues, I believe.
I don't think it's about education. I think it's about
support.
support.
Well, then what is it?
It's about support.
And I think they brought back the old CEO, Iger, and he's thinking to himself, wow.
But he's also doubled down. All right, we got to leave it here.
All right, Kevin O'Leary Ventures Chairman, joining us here in studio. The world. We've got to switch gears though. Kevin, thanks for joining us here in studio. The world of professional golf as we know it has changed. Saudi-backed LIV Golf and the PGA Tour announced a shocking merger on Tuesday to form a new commercial enterprise in hopes to unify golf with the help of Saudi Arabia's Public Investment Fund. It seems like this deal is putting an end to a heated rivalry, and PGA officials recently accused the Saudi government of using sports to polish the country's problematic reputation. For more, we're joined by Yahoo Sports reporter Jay Busby. Jay, very quickly here, we got to know your take on the merger.
I'm as surprised as everyone. I mean, literally everyone up to and including Tiger Woods just found out about this yesterday, only hours before it was announced. It's a huge about face for the PGA, which has spent the last year and a half trying to keep its members and its sponsors and everyone involved away from LIV and the Saudi Public Investment Fund. And then now they turn around and take that money. It's a pretty stunning turnaround.
You know, Jay, we've been getting some reaction from the players, some of whom are not too thrilled, the people who had stayed with PGA and not gone over to LIV. So you have to wonder now the implications business-wise for the sport, because those people don't really have any other options of other places to play.
Right. For the players, there really isn't any other choice if they want to make the kind of money that they make right now. There's some talk already about the players splitting off and forming another tour, but that's just financially impossible, especially to compete with the vast resources that Saudi Arabia has. From a business perspective, this was kind of always how the story was going to end as long as Saudi Arabia stayed interested. You cannot compete with an entity with limitless resources and expect to come out on top if your measurement is by dollars and cents.
Yahoo Sports reporter Jay Busby, thanks so much for helping us break this down. We got to wrap things there, but of course, much more to come as the players are speaking out now, today.
Coming up, should Apple buy Disney? Diane King Hall is going to speak with one analyst who says the purchase would drive adoption of Apple's new Vision Pro. That's next.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Diane King Hall. Here's what I'm watching. The S&P 500 continues to flirt with a bull market, but the macro backdrop isn't rosy. China's exports plunge as the OECD says the world's recovery will be weak and inflation plagued. We ask if the rally can last. The SEC's crypto crackdown continues. The regulator asking a court for a temporary restraining order to freeze assets tied to Binance US. It says clients could have $2.2 billion at significant risk. We look at the possible fallout. And inheriting the family business can be a badge of honor or a financial burden. But what if your parents don't want you taking over? That's the position of more than 50% of business owners in a new study. We discuss your options in that scenario. But first, let's take a look at the major indices. You're taking a look at all three major indexes. We're looking at a mixed market in early trade this morning. Dow holding on to a gain. S&P 500 and Nasdaq under some pressure this morning. Let's do a quick check on treasuries. You're seeing yields up on early this morning, up all across the board, 5-year, 10-year, and the 30-year. Now, tech and mega caps have stolen the show in 2023, up over 30% this year. It's a market contrast from last year when Apple and Co. couldn't catch a break. But since last Friday's jobs numbers, a number of beaten down corners of the market are picking up again and helping to broaden the rally. Here with the details is Yahoo Finance's Jared Blickery. Let's get into it, Jared.
All right, thank you. And let's begin with the Russell 2000. I'm looking at some of these beaten down corners of the market, and you can see it's up 1% today. I'm going to show a little bit of a longer term chart. This is going back 2 years, just to show you where it is in relation to its highs and lows. Actually peaked earlier in 2021, but this gives a pretty good representation of the trading range, and in fact, it really hasn't changed that much over the last year or so. Also want to compare this to the Nasdaq 100, which is a polar opposite because Nasdaq 100 couldn't catch a break this year, but it has been the leader because of the mega caps this year. And you can see it's really climbed a lot farther up in its range. And if we're looking at the high here, you can see it's come a lot more than the Russell 2000. And why do I highlight all of this? Because in a bull market, if this is the beginning of a new bull market, you want to see broad participation. And let me just show you what's gone on in the last few days with sector action. This began on Friday with the non-farm payrolls report, where we got a beat on that headline number. Almost seems to me, based on the market reaction, that good news is good news. So there you go. But here we have energy, materials, each of those up 6%, followed by industrials. Then we got consumer discretionary, financials. So consumer discretionary, a lot of mega caps, or a couple mega cap names in there from Amazon. But you take a look at the top row here, it's all value and cyclicals. And these are the kind of things that you want to see pick up, because I've shown this chart a couple times over the last week, but I just want to highlight this right here is not sustainable. Nasdaq 100, $4.2 trillion market cap this game. Bottom 93, 17% was a bottom 93, and Apple by itself is up over 18. So, in fact, if we do have this broadening out here, I think it portends some nice things for the market. I do want to show you a comparison. This is the Nasdaq 100 versus the Russell 2000, just to highlight how much the Russell has outperformed over the last 5 days. And here's that big jump up that we got on the payrolls report. Now, compare that to year to date, and you can really get an idea. If it weren't for this latest uptick in the Russell 2000, probably be about flat. And as we said before, NASDAQ up over 32%. You want to see something really interesting? This just shows you, this goes back 10 years. This is the huge outperformance in NASDAQ 100, thanks to low interest rates for most of that time. Growth stocks really outperforming, mega caps, the rise of FANG. Guess what? NASDAQ 100 up 383% over the last decade versus the Russell 2000's 90. And going forward, probably going to see that flip if we are in a higher interest rate environment, but it's going to be in fits and starts. Nice to see the small caps getting a little bit of strength here.
Professor Jared in the building. We always appreciate you, Jared. Thank you. Meantime, Apple's new Vision Pro mixed reality headset has been dominating the news this week, getting pretty mixed reviews so far. But our next guest has an idea that could take the product to the next level. Joining us now is Laura Martin-Needham, a senior media internet analyst. Laura, now you said in a recent note that Apple buying Disney could boost adoption of the Vision Pro. What's the case for this?
So the idea is that recall when Steve Jobs invented that thing called an iPod that no one had heard of, he put all the music on there, which gave it sort of a use case for consumers to buy the hardware. Similarly, we have a price point here with these massive like ski goggle looking things of $3,500. I don't think that's going to be a mass product. They need to bring the product down, but they also need sort of a compelling content storytelling use case. And you can't make Disney storytellers do anything for 100,000 units or 200,000 units. So the only way to help that and to create content that's unique for this particular platform, which is what Apple's trying to create, is to actually own the Walt Disney Company and own the very competent storytellers at Marvel and Star Wars and Disney princesses and Pixar, and then have them make unique content for this new platform called Vision Pro.
Hi, Laura. Ali Canal here. How do you view Apple, though, tackling the park side of the business for Disney, especially since that's so heavily tied to its value? Is that something Apple could possibly want as well?
I don't think so. I mean, I think, investment bankers are calling on them. I think that could be spun off into a REIT or sold to a different company. Look, Saudi Arabia seems to be buying things these days. So maybe we sell the parks to Saudi Arabia or one of these big funds. But the point is, no, I don't think Apple wants the parks, but I think the parks are really a good business standalone. So private equity or another kind of REIT kind of real estate buyer would be a logical place for those.
Laura, I got to ask you, though, about the regulatory landscape for an idea like this. I could see this getting pushed back. What's your thought on that?
Well, we did have Amazon. It was able to buy MGM for about $10 billion. This would be larger, obviously, because Disney's trades at over $100 billion. But really, the way the laws are written here, it's not anti-competitive to have a hardware company, or let's call it a distribution company, own a content company. Remember, Comcast bought NBC in a similarly size. They were almost equal size at the time. So, I mean, to me, it is possible the regulators would try to actually block it. But once you go to court, all the precedents allow content to be bought by distribution.
Laura, I want to switch gears here and talk about Warner Brothers Discovery, because we just got the news this morning that Chris Licht is out as CEO of CNN. The stock was little changed immediately following the news. In fact, shares are up more than 3% right now. So what else would have to change in the CNN story for this to affect the stock price, since it seems like right now, at least, investors don't really care?
I think investors who own Warner Brothers Discovery are really betting on David Zaslav, the CEO, and John Malone as the head of strategy on the board. And that's, which is about cost cutting and figuring out the strategic relevance of news. And I think investors aren't investing in specific division heads. Really, the two, brain trust at the top need to figure out how to make this work. And so that's why people are buying shares.
Do you think CNN makes sense in the portfolio of Warner Brothers Discovery? And is it an entity that you think David Zaslav wants to continue to keep?
I do. I think that the only way to win the streaming wars is you must have entertainment content, and you must have news, and you must have live sports. Why? Because the way you drive viewership is when something breaks in the world for news, it drives people to your app, and then you have the option to keep them there with your entertainment content. But if somebody's watching Netflix and there's, suddenly the Ukraine war breaks out with Russia, everybody goes to news for 2 weeks. So they leave Netflix. So if Warner Brothers Discovery has a great news portal, they stay there and they just consume entertainment content, which is sort of on the channel where CNN is. So yes, I think to win the streaming wars, you must own all genres of content in either to attract the next consumer or to retain the next consumer once they're watching your service.
So Laura, to your point about content and bringing Disney back to the forefront of our conversation here, they say content is king, but all of the streamers have an issue in front of them, right? They're dealing with the writer's strike right now, and there is the very real threat of a possible SAG-AFTRA strike as well. What does that do to the content landscape for all of these streamers? Who's the winner in that?
Wall Street. investors, because what's going to happen is all of these companies are not going to be able to spend money on content, and that won't be a competitive disadvantage. The streamers have been in an arms race throwing money at new content. The more of these guilds that go on strike, the longer these companies are not going to spend any money on content. Guess what happens to their reported earnings per share and their profitability? And they don't have to worry about competing with each other because no one has new content. So this is going to be great for investors and for the earnings per share and free cash flow. It's not a long-term solution because ultimately you need these guilds to go back to work. But in the near term, I expect earnings outperformance for the next 12 months.
We will certainly see what happens with SAG-AFTRA already voting to approve a strike. So they're in the beginning of negotiations. We'll see how that turns out. Laura Martin, Needham Senior Media and Internet Analyst, our very own Ali Canal as well. Thank you so much to both of you. Meantime, shares of Affirm surging today on news that Amazon will let U.S. retailers that already use Amazon Pay offer Affirm's buy now, pay later services. Amazon customers have already had access to Affirm, but adding the adaptive checkout service to Amazon Pay allows for easier access to the pay later feature. Now, Affirm has rallied year to date as the consumer has remained resilient despite high inflation and recession concerns. So year to date, you're looking at Affirm up more than 80%, up double digits on the day as well. Coming up, we've got more market coverage and a look into the shakeups in the crypto markets and the golf world. Stay with us. On Tuesday, the Securities and Exchange Commission sued Coinbase, the U.S. crypto exchange, alleging the company violated federal securities laws. This comes after the SEC also filed a similar suit against Binance on Monday. We've got Yahoo Finance's David Hollerith here with us, digging into what's happening. David, take us through the latest.
Yeah, these lawsuits have been anticipated in some form for both companies for months. And it's worth pointing out, these are crypto's two largest companies. So while this is anticipated, it's a big deal. And the charges for Binance and Coinbase aren't exactly the same. Coinbase is facing a dynamic that essentially all U.S. crypto exchanges need to deal with, which is whether or not they have listed unregistered securities, at least according to the SEC's framework. And there's room for argument on both sides, and it varies depending on each token. So this is a very gray area. Coinbase has also said as far back as February that they would defend charges or claims in case the SEC were to levy these. The SEC obviously sent them a Wells notice last year. And so they've been aware of this for some time. But with those same charges, the SEC is also alleging that Binance has done some other things, such as wash trading, using a hedge fund owned by the CEO for market making and commingling funds. And we don't know to what end. Again, these are all allegations, but if proven to be true, that looks much more akin to something like FTX, which obviously we know was a pretty horrific collapse that occurred in November. But it's important to point out that the SEC is seeking a preliminary injunctive relief for Binance, which means if granted in the courts, they would freeze at least Binance's U.S. entities' assets. That being said, we're watching the funds flowing out of both exchanges. And we've seen since Monday, when the outlook was particularly bad, that outflows have been tapering off. So they're not as bad as they were Monday, and they have been easing, though in general, the net transfers are still negative, showing that customers are still taking out their funds, but it doesn't look anything like what we saw in the days after FTX. And that's obviously a really important thing to point out.
Yeah, to your point, though, there do seem to be some differences to some of the allegations between Binance and Coinbase. You're right. It does seem like the allegations against Binance are more serious. And you're right. The SEC also telegraphed this previously. But I saw the news yesterday, them putting out the brief seeking a court order to freeze Binance assets. Coinbase defending itself on Twitter. Is there any silver lining here with regard to how the SEC is coming after these big players within the crypto space?
Yeah, I mean, I think people, a lot of crypto investors and insiders in the space will take like a longer term view about this. And they will say, I have heard things like, longer term, this sort of brings up sort of the clash that crypto has had with the SEC sort of to the courts, which is ultimately maybe not the ideal way it would be decided, but it's a way to, force an outcome. And that would mean regulatory clarity for crypto investors and entrepreneurs in the space. So that would seem like a good thing. Another silver lining, I guess we could point out, is that Bitcoin is largely considered to be a commodity. There's no written law about this, but just based on public comments or personal views from the SEC chair, Gary Gensler, as well as the CFTC chair, that seems to be the case. And I've never seen an argument that would point out that Bitcoin is a security. So Bitcoin investors do appear to be in the clear more than others. And we have seen within the industry, Bitcoin seeing more flows. Its market cap relative to the total crypto market cap has been spiking since yesterday morning.
All right. Well, we will certainly continue to watch this crackdown on crypto and see where this lands, Coinbase and Binance. David Hollerith, thank you so much for breaking that down for us. Meantime, a big deal in sports and business has startled the world of golf. Yesterday, the PGA Tour announced a merger with the Saudi Public Investment Fund and the DP World. The golf landscape could see a lot of changes in the coming months, so too could the players. We're joined now by Patricof co-founder and CEO Mark Patricof, alongside Yahoo Finance's our very own Josh Schaefer. So Mark, let's get right into this. There was certainly seemed like a big outcry with regard to this deal. They went from foe to friends and kind of a strange bedfellows. How do you take this?
Well, if you remember what James Carville said in the 90s around the Clinton campaign, it's the economy, stupid. I mean, at the end of the day, this was all about money. I don't think it ever was anything else. And I think the PGA was put in a pretty bad spot. Maybe they put themselves in that bad spot. They couldn't afford the lawsuits. They couldn't afford the growing purses. And unfortunately, to some extent, they were in a position where they had very little option but to do this merger. And now you have a global entity that will not have a lot of competition, obviously, but it won't have a lot of people to answer to either.
Mm-hmm. And with the Public Investment Fund, I mean, how big do you think this could go as far as their investment into sports? It seems like this was their first successful, infiltration of a league, but I think the question kind of then becomes, they're trying to do it with soccer maybe a little bit. People have floated the NBA now takes sovereign wealth fund investments. I mean, where do you think this goes for what the PIF is interested in and sort of what they're trying to get out of it?
Well, PIF aside, you've seen private equity enter sports over the last couple of years. You saw Silver Lake do the deal with the All Blacks in New Zealand. You're seeing all kinds of things happening across the landscape of sports. If they think this is the right way to enhance, A, their reputation, sports washing, but B, just their ability to generate returns in a smart way and satisfy some other objectives they may have, they'll do it. And this is a big first move for them in terms of that kind of scale. But look, they're also investors in Uber and Amazon we talked about. Mm-hmm. And it's not the first time they've invested in global and U.S. national businesses that are relevant.
Let's talk about a little bit more about the backlash, particularly when it comes to some players. You have Rory McIlroy sounding off on saying, he hopes it goes away. You had Tiger Woods ahead of this talking about the Saudi League and criticizing them, saying that the gobs of money is not a way, and paraphrasing, to create legacies. What do you think about how this will impact players?
Well, first of all, we've seen just in general in sports, players have a much louder voice than they ever had before. You're seeing players become owners more frequently. Dwayne Wade bought a piece of the Jazz. You saw Brady buying a piece of the Raiders. This is a trend. Lionel Messi chose, Inter Miami instead of going to the Middle East to play. I mean, the players have a voice, a louder voice, but at the end of the day, if there's only one organization, their leverage is minimized by the fact that if they want to get paid and want to play in the international circuits, and they want to be on television, this is where they're going to have to be. So that was the move. I mean, look back to the USFL and the NFL in the 80s.
Yes. Mm-hmm.
Donald Trump involved the USFL. That was a move that they made. They split their talent in half. At the end of the day, the USFL won in court but lost on the field and ended up going away.
Right.
This is sort of analogous to that to some extent, although the outcome for LIV was better than that of what it was for the USFL.
Do you think people care in the long run? Do you think this is something that we're still talking about in 5 years in regards to the PGA Tour? Or has it just become less of a story after a few years?
No, I don't think in 5 years it will be relevant because people want to watch golf. They play golf. It's a great sport for that reason. People can participate unlike tackle football. So I think if that's where you can see the greatest golfers in the world and that's where you can watch the greatest golfers in the world, on television, that's what you'll watch and the dialogue and the murmur will kind of die down. But there will be other ramifications. Sponsors, other companies that have taken in this type of money will have a point of view, and this is a really important kind of flag to them to figure out what it means.
We will certainly continue to watch this one because, there's been so much backlash about this. You wonder if there is any upside and what that is. We're going to have to put a bookmark in our conversation, though. We appreciate you so much for joining us and breaking this down for us. Our thanks to Patricof, co-founder and CEO Mark Patricof, alongside our own Josh Schaefer. Coming up, would you let your kids inherit your business? A new survey from Wells Fargo gives a split picture. We'll discuss. That's next. Inheriting the family business. It can be a badge of honor or a financial burden. A new Wells Fargo study found that 52% of business owners do not want their children to run their business. For more, we're joined by Michael Liersch, Wells Fargo Head of Advice and Planning. So, Michael, let's get right into this survey. So I was a little bit surprised, not completely surprised by this. What stood out to you?
Well, what stood out to me, and maybe this is where you're particularly surprised too, is that not only did business owners say they weren't necessarily wanting or expecting their next generation to help take over the business, but in fact, a large proportion, 44%, were worried that their children didn't know how to build and protect wealth. So it wasn't only just the idea of taking over the business, but also did they have the knowledge, the ability, the capabilities to really understand finances, really understand how a business works. So there was a lot of interesting findings along those lines.
So, Michael, I got to ask, have you watched any Succession? I know it's off.
I don't watch Succession personally, but a lot of our customers and clients do, and they have a lot of thoughts about it. Yeah. And I think the thoughts about it seem to rhyme a bit with, I think, where you're going with this. So what are your thoughts on Succession?
Well, I was going to say it feels a little bit like life imitating art. I didn't watch all of the episodes of Succession, but I watched enough to know that there was really this battle for carrying on the legacy. And, you know, the children were vying for that, but it was tough to hand over, you know, so that kind of plays out in some of the numbers that you're talking about with us. But where were these families willing to kind of, you know, help their next generation?
So the very positive part about all of this, so moving on from TV programs that maybe sensationalize a bit of these dynamics, is that actually a vast majority of the wealth creators that we surveyed said that they wanted to enable their children to carve their own path in life. So over 90% said that, and that they were willing to really invest in those ideas. So things like education, you know, came out at the top. Things like helping their children become homeowners, and also invest in a way that would be productive came out as top. So they're willing to help their children build those skills. The idea is that they were just concerned that maybe in the face of having wealth or in the face of having the opportunity to run a business, they might not build those skills by a matter of necessity. So they realized they had designed those experiences for their children, if that makes sense.
So I got to ask you, Michael, in that context, I've seen data before, I don't remember the exact source, but where the next generation, they followed kind of this formula. The previous generation did not pass on the family business, and the next generation basically kind of squandered the wealth, and then that leads the following generation to have to rebuild and start all over. Was there any conversation around that and kind of the fallout of not passing on the family business?
Absolutely. So that's called the shirt sleeves to shirt sleeves phenomenon, and it exists across the world. So the idea here is that 70% of the time by the next generation, all the wealth is lost or dissipates. And by the third generation, 90% of the wealth is lost or dissipates. And that was a key concern of about 44% of the respondents, that would happen. And so what was interesting, though, is that they acknowledged then that the focus should be on the values. What are the values related to money? And 3/4 of the participants said they were very focused on sharing financial values and passing those along, and they felt they had done a good job. The one watch item that they had, and especially Gen Xers that they had for themselves, is that even though they're transferring those values, sometimes they like to help a bit too much. Soothe and smooth situations, help support or get kids out of trouble when they probably should learn their own lessons. And the respondents acknowledged, especially Gen Xers, so people born, let's say in the 70s, knew they were doing those things, and that may actually make kids less able to make it on their own, and they needed to work harder on that.
That's an interesting point, because as a parent myself, I can certainly understand the desire to help. You know, because you don't want to just leave your kid completely out there, but I guess there's a way to do it without leaving them hanging.
Exactly. You want to create that resilience. And so how do you do that? The respondents acknowledged the number one thing is through hard work. The second thing is through education. And the third is really through this idea of just working through a lot of different cycles and in a land of opportunity. So they acknowledged living in the United States, for example, is a huge plus. And then what's interesting is they said, and there's a bit of luck involved in all of it too. So that hard work, living in the US as a business owner, and that education, pepper in a little bit of luck, and then that's what makes someone successful, and that's what they want to pass along to their children.
All right, we will have to leave it there. Michael Learsh, Wells Fargo, Head of Advice and Planning, thank you so much for joining us today.
Thank you so much.
All right, time now for our chart of the day. Some upside for Bud Light Brewer AB InBev amid the controversy relating to its partnership with trans influencer Dylan Mulvaney. Volumes for the business improved slightly, down 27.8% during the week of May 27th, compared to down 29.5% the week of May 20th. That's according to data from Bump Williams Consulting, cited in an Evercore note to clients. Evercore saying it was, quote, another week of very weak trends for Bud Light, but the firm sees the possibility of stabilization for the company and that volumes are still significantly lower than a few months ago. Coming up, have you been keeping track of the prices at your local grocery store? Break down how inflation is still impacting your bottom line. The White House is out with a new blog post about grocery prices and their recent dynamics. Yahoo Finance got a first look. Our own Brooke DePalma joins us now to bring us some of that data. Brooke?
That's right. Yeah, well, the White House is out with those 5 facts about what they say is the latest when it comes to grocery inflation. Now, this comes ahead of the next CPI print set to be released on Tuesday, June 13th, before the market open. Now, the first fact here, grocery prices matter to Americans. It makes up about nearly or more than 10% of consumer total spending. And because of that, grocery prices have a significant impact on how Americans talk and think about inflation, saying when groceries cost more, American households incorporate that into their expectations of future overall inflation in the near future. So how they view and future will pan out in the near future. But the good news here is that the Council of Economic Advisors say that prices are dropping, what they refer to as cooling. Of course, we know that groceries make up about 1/10 of the overall consumer basket. And so on a 3-month average, we're seeing grocery prices drop about 0.9% in April. So that's good news. Once again, May data expected to come out next week. And what we also know is that there is now less upward pressure on grocery inflation. We're seeing decline in egg prices. We're seeing decline in produce like fresh fruit. That's driving grocery inflation down. Of course, last month we saw egg prices drop 1.5%. And on a 3-month basis, egg prices dropped 18%, but they're still higher year over year. They're up about 21.4%. Of course, that was shell shocking earlier this year when shoppers saw that on their shelf. Now, something not mentioned within the post, but something that Yahoo Finance is tracking significantly here is the price of sugar. We've seen sugar prices see a recent increase. We know that futures are higher compared to a year ago. And when we asked J.M. Smucker, CEO, of course, that's behind so many different consumer product goods like Jif peanut butter. He did say that right now their view is that we are still in an inflationary environment. So the White House saying that inflation is cooling a bit, but major executives still seeing a bit of sticky inflation there as well.
Sticky inflation. We are certainly seeing that. I mean, look, although prices have come down, they still really haven't cooled enough. This is a personal perspective here. I mean, look, sure, egg prices are down and some prices are down, but we want more relief. Right. What can we expect?
Right. Well, prices are expected to remain higher this year. And in a quote from the Council of Economic Advisors, they say, looking ahead, the staff expect grocery inflation to continue improving alongside headline inflation, but remain elevated relative to its pre-pandemic levels through the rest of 2023. So essentially, through the rest of this year, we can hopefully expect some declines. But prices are not going to go back immediately to what they were prior to the pandemic in 2019. Of course, Diane, we've seen egg prices see some relief as these U.S. agriculture industry continues to rebuild the flock. But we're still seeing higher prices, and we just can't get away from that just yet.
So 1 egg instead of 2. And a teaspoon of sugar instead of a cup.
That's right, Diane. we're making ends meet here.
Exactly. Our banana bread's going to be a little different compared to the pandemic banana bread.
Exactly. Maybe 1 less sugar than
exactly. That's right. All right. Thank you, Brooke DePalma. Investors are keeping an eye on next week's Fed meeting. The big question, will it pause or hike rates? But how does this impact your retirement savings? We're joined now by Gen Wealth financial advisor and host of Get Ready for the Future show, Scott Inman, to discuss more. So let's start with that. The Fed expectations next week. We don't know whether it's going to pause, skip, or hike. Does it matter in terms of one's retirement?
Yeah, well, first of all, thanks for having me. You know, I think it matters in the short term, but it doesn't matter in a long-term plan for retirement. I would say this. When we tell our clients this all the time, your decision on whether to retire or whether or not you have reached true financial independence should not depend solely on your account balance and should not depend on what the stock market does over a short period of time and should not depend on what the latest Fed decision is when it comes to raising interest rates. When it comes to retirement, the outcome is income. Now, certainly account balances play a big part of that, but your investment strategy is really built in retirement to provide you a stream of income for your basic lifestyle. So you can pay for those eggs and all of those things you talked about in those grocery prices and give yourself a raise in income over time, because we know inflation, even if it does cool, is going to be hanging around throughout your retirement.
So, Scott, I got to ask, we've seen data where people are having to push back their expected retirement age, whether we're talking about baby boomers or older Gen X. What is your advice on when you pull the trigger on when you should be retiring? What should your financial picture look like?
Well, I think it is a combination of income and assets. So unless you have put together a plan on very specifically and dynamically how much monthly income you're going to be able to receive over the course of time from your assets, when layered on top of Social Security, maybe there's a pension, what other guaranteed income sources you have, that's when you have a clearer picture of whether you can retire to not. So it's not an age and it's not an asset number. It is an income solution. And that comes from, for us here at GenWealth, creating a retirement income plan written on paper on purpose so that you can see what your income will be. And that allows you to make an informed decision of maybe I need to continue to contribute and grow that asset level for a couple of more years, or maybe I'm ready to go right now. You won't know unless you plan.
Is the 60-40 portfolio still the way to go?
Not for us. This 2022 was a real good reminder that the 60-40 portfolio can have a really rough go at it. It was one of the worst years on record for a quote unquote balanced portfolio. So we believe a simple withdrawal strategy, which really doesn't designate what you sell and when you sell it. That's what we're trying to do here. We tell our clients all the time, it's not about the economy, it's about your economy. And that really just means control what you can control, right? And what we can control when it comes to investment is the strategy and the withdrawal strategy, meaning let's sell from the less volatile, more conservative end of the investment strategy. Right now, that might be cash and CDs, right? Because we're getting pretty favorable interest rates on a short-term CD. We may be able to ladder that and get the income for today and the next year from that because we know that it's not going to be volatile. And we're able to push the volatility down the road, the equity part of your portfolio. And we do believe you need to still believe in equities because you have to have that growth component even in retirement. It's not a stop sign when it comes to investment strategy. It's just simply a yield sign. But those equities, those stocks have to be positioned for long term. We're not intending to sell anything in a down market. We're pushing that down the road to allow time to heal all wounds, if you will. So 60-40, that's two asset classes, and there are more than that. We believe you got to take a look at alternatives, cash, other instruments to build a more dynamic investment portfolio.
That's a great perspective because just to give a personal anecdote, I remember my grandmother when she was getting towards the end of her life, there was a lot of concern about would her life outlast her money because she was so heavily invested in bonds. And I think there is skittishness with older people when they're in retirement about just the safety of what's to some people a risky security, stocks. But, you make a good point. It's really that barbell approach when you come to your investments. But let's talk about younger generations. They always say it's never too soon to start. And I saw some recent data that surprised me in a good way about Gen Z and responsible financial habits. Now, that data was looking at their credit usage, and they weren't using it as much as I expected, using more on debit cards and cash, and just 17% relying on credit cards. But what do they need to be doing to preparing for retirement, especially because they're very early in their earning years for the ones who are adults?
Yeah, and it's really hard to have that long-term perspective when you're just trying to pay the bills, you're just trying to raise some kids, right? You're not looking that far down the road. But the reality is getting started early, and the data shows this, makes more of a difference than putting in more late, right? Because of the time value, the compound growth that happens over a very long period of time. And it can be a very small amount. I would recommend sitting down for younger people with an advisor and figuring out a budget, because that's the only way you're going to determine if you have some money to save, right? You've got to be able to spend less than you make, create some margin, create some positive cash flow. And then even if you can throw $100 or $200 a month at a Roth IRA, for instance, and do that over a long period of time and eventually max that out, it's going to be very, very good for you over a long period of time. And then, of course, I would say, too, if they have an employer, you got to get into that 401k and get the employer match, because you're leaving money on the table if you don't at least contribute enough to your employer plan to get the money they're going to match.
That's right. I mean, maximize that match. Couldn't agree more. All right. Thank you so much, Jen Wealth, financial advisor and host of Get Ready for the Future show. Scott Enman, great advice. Thank you so much.
Thank you.
Coming up, big news for AWS simulation software. Our very own Dan Howley caught up with an executive from the company. We'll share that interview. That's next. Amazon Web Services with a big announcement this morning. Their large-scale simulation system is now available for government clients with compliance requirements. Introduced last year, AWS's SimSpace Weaver allows for testing of large-scale scenarios and using those results to plan and train for real-world responses. Now, governments at various levels can test using their sensitive data. Big news for disaster and emergency scenario planning. Our own Dan Howley spoke with Max Peterson, Vice President of Worldwide Public Sector at AWS, about the system. Take a listen.
Everybody's going to be excited to join us here at the Worldwide Public Sector DC Summit. And part of it is because of generative AI. Amazon has made a number of different announcements. Customers are used to using Amazon machine learning and generative AI, and they may not even realize it. Where you do personalized shopping, whether you talk to Alexa, whether you go through Amazon Go and check out. So at the summit here today, we're going to be talking about the latest AWS services to help customers build and deploy generative AI solutions. Bedrock provides a simple, easy way to let people deploy Gen AI solutions using pre-trained models. The AWS cloud infrastructure is the most cost-effective way for you to train and run these types of models with Inferentia and with Trainium. And finally, we've got customers that are building actual large foundation models, not just using them on AWS. And so we're excited to be able to talk about the Technology Innovation Institute, which is the technology and research arm of the Abu Dhabi government that trained the Falcon 40B large language model on AWS SageMaker. And they have surpassed the sort of performance, training, and cost barriers that many others haven't. And we're excited to acknowledge and congratulate them on the fact that they've been recognized on the Hugging Face Large Language Model Index as the world's #1 LLM right now.
So, talk about that, the generative AI aspect and the training and deployment. That's obviously something that's very costly. We've discussed it with, regards to OpenAI, Google, Microsoft. What does this do then for companies that, outside of your main competition? What does it do for companies then when you're talking about the training, the deployment of generative AI, of these large language models?
Many customers are just not going to have the time, the resources, or the inclination to train their own large language models, their own foundation models. And that's where we believe that Amazon Bedrock is going to be the way for more customers to be able to actually put enterprise and government class AI and generative AI applications into use. Bedrock makes it easy for customers to use pre-trained models like Amazon's Titan 1 or Titan 2 models, or like models from Stability AI. And these pre-trained models have known data provenance. They have known uses. They're ready to be used on AWS in a customer's private virtual cloud with the customer's confidential and oftentimes private information to be able to train and enhance these already good models to use them for your purposes, to be able to have a much better conversational discussion with a citizen about government services, or to be able to use in a case of an assistant or a co-pilot and quickly summarize a vast amount of information so that the person can make a better and faster informed decision, whether you're a law enforcement official or whether you're a defense analyst.
One of the announcements you guys have is something called Slim Space Weaver. It's basically a way to provide governments with security and compliance requirements. It meets those, but it's meant to be kind of a simulation and training platform. Can you kind of explain what that is? Is this the idea of digital twins, kind of the government, public sector getting in on that? And what does that do for them?
Yeah, one of the most dynamic areas is with governments who realize now that they need to have much more comprehensive planning exercises. So for instance, with digital twins and using SimSpace Weaver, governments can model thousands or millions of different variables and create really complex simulations in 2 or 3D to allow them to do things like complex traffic flows, in cities around the world, and making it easier to be able to model what happens with a construction change or with a road closure. And how do you wind up using the simulated digital twin to create a better outcome in a live environment? Many of these things, like emergency planning, can be conducted much more capably using a simulated environment, a digital twin, because you would never create these kind of large-scale disaster scenarios, in reality, but you still need to be able to prepare for them. So what's exciting about the SimSpace Weaver announcement at the summit is that it's now available in the US Gov Cloud, which is the cloud that is used for security and compliance by national, state, and local government customers and companies that are building solutions for these types of customers. So AWS SimSpace Weaver is now available in the AWS Gov Cloud.
So you have SimSpace Weaver, you have, generative AI. I guess just as a final question, we talk about generative AI a lot where, it comes to businesses, it comes to, creativity. Where does it go as far as the public sector goes? Where does it benefit the public sector?
Well, as I talked about just a second ago, there are a lot of applications where government or healthcare organizations or educational institutions can use generative AI to deliver better service for citizens, a more immersive conversational environment, for instance, or better outcomes for students to be able to help them quickly find the right resources and aid their studies, or better outcomes in healthcare by being able to quickly summarize vast amounts of information for that clinician or the medical practitioner so that they can focus on the patient and not focus on all of the information gathering and assessment pieces that tools like machine learning, AI, and generative AI are going to help customers with.
All right, that was our own Dan Howley, who's speaking with Max Peterson, Vice President of Worldwide Public Sector at AWS, about the system. That's it for now. I'm Diane King Hall.